Yep.
All right, you can start whenever.
Thank you very much, Dawn. Good morning. Welcome, everyone. I would like to call the first public hearing of the Banking Committee to order today, March the 1st at 9:06. Before we begin, I want to give my co-chairs and co-chair and the ranking members an opportunity to make any opening remarks. Representative Doucette.
Good morning, Madam Chair, and good morning, everyone. Happy to be here. Unfortunately, not in person, but this is good too. Obviously, has its conveniences, I think, for folks to be able to testify without coming up to Hartford. So it's a double-edged sword a bit, but I trust we will be back in the building and see each other very soon. So I'm excited to get going. I'm glad we have a good list of folks this morning to testify on these bills. And I also want to welcome our newest member on the House side of the committee, Representative Pizzuto from the great city of Waterbury, right?
And Middlebury, right?
And Middlebury. Welcome, Rep. Pizzuto. I think we were just chatting that I think you're going to like it here on the Banking Committee, and we're very happy to have you.
Thank you very much, Representative Doucette. Thank you.
Thank you, Rep. Doucette. Senator Bertho.
Good morning, Madam Chair. Thank you. Good morning, everyone. Glad we're getting the most important part, arguably, of the committee process underway for the Banks Committee is hearing from the public and having their voices being heard. I will echo my welcome to our new representative from the 71st District, Waterbury, and all of the great town of Middlebury. And I will just be, for the record, as we spoke before we went live, I do have some conflicting interests today and may have to pop on and off of this public hearing. It certainly does not indicate my lack of support or interest in being here. It's just all in a day's work, I guess we like to say. So thank you, Madam Chair.
Thank you, Senator Bertho. And the interesting part is if we were in the building, we'll be running in and out of the committee room. So thank you for that.
Sure.
Representative Delnicki. Good morning, sir.
Good morning, Madam Chair. Good morning, Mr. Chair. Good morning, Ranking Member, and the remainder of the committee. And a big shout out to our new representative on the committee, Representative Pizzuto. It was a pleasure meeting you yesterday, and you're swearing in, and now we get to work, literally in less than 24 hours from your swearing in ceremony yesterday. And I think you'll enjoy the time here. We're a tremendous group, and we work together in such a positive fashion. And I'm looking forward to the public hearing today. And let it begin, Madam Chair.
Thank you, Representative. And again, I would like to welcome you to the committee as well, Representative Pizzuto. It's an interesting committee. I've been here for 12 years and I'm learning something new every day in every committee. And so, but it is a committee where we do work well together, and that's been my experience thus far. And I have to admit, we don't have that many of those committees here, and it would be great if we all could work together as well as this committee does, and as well as another committee that I sit on. So, we take care of the people's business, and we all have our different views. But one thing I can say about this General Assembly is that we respect one another. So although we have different views. So again, thank you so much for joining us. So getting to business, I just want to talk about public hearings. Public hearings are a very essential part of the legislative process, and it gives the people an opportunity to voice their concerns on different issues, as well as give not only the public, but also us an opportunity to learn additional information, as well as clarity on different issues. So I want to thank you all again for joining us today. And I would like to go over a few procedural things before we get started. So if you would indulge me. So the hearing will be conducted at a slower pace to accommodate the quality of live stream. So we're live streaming on CTN as well as YouTube. I know that this will not happen on this committee, but I think it's important that I bring it forward anyway. Disruptive or inappropriate behavior will not be tolerated and may result in expulsion from the meeting. People who are ejected from the meeting will not be readmitted. The first hour of testimony will be reserved for public officials, followed by members of the public. If we do not complete the public officials list within the first hour, we will alternate between the two lists. Comments will be limited to 3 minutes, followed by questions from the members of the committee. Our clerk, Dawn Mazik, will be the timekeeper. Members, I ask that you limit your remarks to 2 questions to give other members the opportunity to ask their questions. Once other members have spoken on a testimony, you may continue your remarks. I ask that you do not use the chat function, which should be turned off. And all participants, I ask that you mute yourselves until you've been invited to speak. Members, raise your hand. There's a virtual hand to signify your desire to speak, and please wait to be recognized. For those of you that are on the phone, you can press *6, that will mute and unmute you. And if you would like to raise your hand, *9. You can have, and this is for members in the public as well, but you may have access to the speakers list by going to the Banking Committee's page on the CGA website, click the Public Hearing tab, then click the Testimony tab, and then the March 1st tab. And that will give you a list of the speakers that we'll be calling on today. So let's get started. Our first speaker is Jorge Perez from the Connecticut Department of Banking.
Good morning, everybody.
Good
My
morning,
name is-
Commissioner.
Good morning. For those who don't know me, for the new members, my name is George Perez. I've been a long-time resident of New Haven in the past. I lived there for 42 years and was a banker prior to becoming the commissioner, which I've been the commissioner now for almost 7 years. What is it? In 14 days will be 7 years. I was a banker for almost 34 years. Matt Smith from my office will be doing the major testimony, and then I'll be available for questioning, if that's okay with both chairs on a both committee. So I'll turn it over to Matt, and then I'll stay on, and I'll answer any questions that may come up. And thank you for this opportunity. Matt?
Great. Thank you, Commissioner. Good morning, Co-Chairs Miller and Doucette, ranking members Berthel and Delnicki, other honorable members of the Banking Committee, and a special welcome to Representative Bizzuto. This is your first public hearing, so it's a pleasure to be a part of that.
Thank you.
My name is Matt Smith. I'm the Director of Government Relations and Consumer Affairs for the Connecticut Department of Banking. I'm joined by Commissioner Perez, as you know. Thank you for the opportunity to testify today regarding 2 bills. The first one is Senate Bill 178, an act requiring the Banking Commissioner to consider the performance of certain banks under the Community Reinvestment Act before approving the establishment of certain loan production offices and the establishment of a working group to examine the Community Reinvestment Act. I think it's good to start off with a little bit of background. Each bank is given a rating on their compliance with the Community Reinvestment Act, also known as CRA. These ratings vary from outstanding, satisfactory, needs improvement, and substantially non-compliant. Those banks who receive a failing CRA rating, like the substantially non-compliant, face limitations on their ability to grow, merge with other banks, as well as other regulatory restrictions. Currently, out-of-state, state-chartered banks with an unsatisfactory Community Reinvestment Act rating in their home state can come to Connecticut and seek permission to open a loan production office here in Connecticut. This could include a business strategy of opening offices only in our high income assessment areas. Such strategies are designed to circumvent the CRA and pose a risk to not meeting the credit needs of low to moderate income consumers. Give me 1 second here. Current law does not allow the department to consider the bank's current CRA rating when considering whether to approve such application. The department has faced such a challenge in the past and has lacked the legal authority to present such actions. Sections 1 and 2 of the proposed legislation allow for the commissioner to consider an out-of-state, state-chartered bank's CRA rating when reviewing an application to open a loan production office here. Such consideration would help ensure that only responsible out-of-state, state-chartered banks receive permission to access Connecticut's loan markets and provide the additional consumer protections these laws were designed to do. Section 3 of the proposal establishes a working group to examine the Community Reinvestment Act. The department believes that establishment of such a working group is a good idea, but may be premature to do so this session. As you know, CRA was enacted in 1977. Since then, it has only seen 2 updates, once in 1995 and once in 2005. The 3 federal regulators, the Office of the Comptroller of the Currency, also known as the OCC, the Federal Deposit Insurance Corporation, known as the FDIC, and the Federal Reserve Board, saw the need to modernize the CRA. The process to modernize began with each of the federal regulatory agencies working independently. Under the current administration, the regulators have now committed to working together to provide new rules that would modernize this law. This was confirmed after the conclusion of last year's session in a joint statement put out by all of the regulators. We do acknowledge that this process has taken longer than anyone would have preferred, regulators and industry alike. However, we believe that the new rules will be published in late spring. In fact, this was confirmed just yesterday in a meeting attended by the commissioner and our general counsel. We therefore respectfully ask the committee to delay the forming of this task force until such time that the federal regulators have issued these new proposed rules. This is critical to reviewing the CRA in Connecticut because it will provide guidance and context for the state. In addition, it would eliminate the risk of determining new regulations that could be in direct conflict with any federal rules that may be adopted and would avoid any industry confusion as a result. Moving on to Senate Bill 183, an act concerning fair lending. The department supports the spirit of this bill and remains committed to ensuring all Connecticut residents have fair and equal access to credit. Strengthening anti-discrimination policies by codifying it directly into the banking statutes and applying these standards to the mortgage industry is an important addition. Historically, hold on, I lost my place there. Historically, enforcement of the Fair Credit Reporting Act, the FCRA, has remained with our federal counterparts. The department does have concerns, however, on the timing of this initiative. We think it is important for industry to adapt to the new landscape, and we would need time to educate them on the impacts of these new exams. The department would also need more time to coordinate such exams with our federal counterparts, should the need arise. Given this new layer of complexity, it is important to note issues concerning staffing of these exams. Typically, it could take anywhere between 3 to 5 years to fully train examiners employed by the department to conduct these exams and ensure the safety and soundness of our financial institutions. These new exams would require highly specialized knowledge and skills and offer an additional layer of complexity. The department, like all state agencies, are facing impending employee retirements, thinning our capacity. We have already seen over 1/4 of our staff retire, and many more are qualified and ready to do so. This is particularly true in our financial institutions division. Despite these challenges, the department has begun the process of developing a new unit to focus on complex, critical, and emerging regulatory risks. These include fair lending, fintechs, cybersecurity, crypto assets, and climate change. The department would welcome the opportunity to keep the committee informed of our approval process as we navigate these expected staffing challenges. We look forward to working with all of you as this moves through the legislative process. Thank you again. That concludes the testimony for today.
Thank you, Matt. So Matt, I have a question on 178. Have we had any instances where out-of-state banks have taken advantage of that loophole in our state?
Madam Chair, I will answer that question if it's okay, because that's how this whole thing started. Yes, we had an entity out of Arizona who had failed CRA in their state, and therefore they would not have been able to grow in their state. Came here, applied to open a loan production office in Greenwich and in Guilford, and I always get the Hartford's wrong. East Hartford, I think it was. Because they have failed and they were accused and it was proven that they were have committed redlining, I wanted to deny the request. FDIC approved it, and I was told by the lawyers that I could not do it because current state law does not give me the power to do that. As you all know, I only have the ability to enforce whatever statutes that you guys give me permission to do. I know that there's some people think that I, make up the rules myself, but my ability to enforce law comes either from federal regulation or state regulations or statutes. So yes, that's how this whole thing started, Madam Chair.
Okay, and so thank you for that, Commissioner. On the modernizing the CRA, the work group, you said that you would rather wait for the federal statutes the federal law to come down regarding that?
Sure. Before I answer that question, I do want to also state that concerning the out-of-state entities coming in here, if you were a Connecticut State Charter Bank, that rule applies, right? So I would be able to consider UCRA, but I cannot do it for an out-of-state entity who's state chartered, which again puts our state charter institution who pay taxes in Connecticut, right, and hire people in Connecticut, and hopefully make all of our quality of life better, at a disadvantage. But going back to the CRA, one of the things that I get a lot of complaint about from the industry and even the consumers, because they get confused, right, when you have conflicting laws or slightly different laws, is that sometimes you have conflict, right? So in order to minimize that, and we have ended up in court, like student loan, we ended up in court and we lost, right? And there've been a couple other statutes that because we got ahead of the federal government, we ended up in court and we ended up losing, which doesn't do any good anybody, right? Spends a lot of money. With all due respect to the attorneys, the only people that make money in this is the attorneys. And we have a frustrated consumer group that says, but I thought the law says this, right? So my suggestion is, since this is going to change and may change dramatically, that we get an idea of what those changes are going to be and then be able to react to it. So we don't end up in giving people false hope or people thinking they could do something that the federal law may not allow us to do.
So Commissioner, do you know if that's something that's going to happen soon, within the next year? Is it in the pipeline now down in Washington?
They already have according to this meeting, let me back up a little bit. And I know some of you know this already for the new members. The country is divided into 5 districts for purposes of regulators. Like we're part of District 1, which is all the New England states, all the way to Philadelphia. And every banking commissioner in those states are part of that district, right? Plus, for whatever reason, District 1 includes all the islands, Puerto Rico, Guam, Samoan Island, the Virgin Islands, and Hawaii, believe it or not. Even though Hawaii makes sense to be in California district, they're in our district. It also includes the regional president of the FDIC and the presidents of the Federal Reserve Board and representatives from the Office of the Comptroller and CFPB. So our quarterly meeting was this past Monday. So this is one of the topics we discussed. So they claim they already have their proposed law pretty much done, 99% done. and they're expected to put it out. And this, they actually say April. I'm saying the end of spring because it's government and they have not met one deadline yet. And I don't mean to be critical. It's just the nature of the beast, especially something this difficult. Then that will be available. So all those rules are already done because all the public testimony, all that stuff has been taken already, right? So once we know what those rules are, then we know how to change or what we could change in our laws, right? So we really need for the federal one to pass to give us the guidance, the template of what we cannot surpass, right? Am I making, does that make sense? Yeah.
Making sense. I'm just making notes because I have to be respectful. You know, I have to practice what I preach. I can only limit my questions, so I'm just making notes.
And also, I'm more than willing to meet with people afterwards, you know, in the committee anytime. In fact, in the very near future, I will be anybody from the committee could come, but specifically you and your co-chair, the chairs, I will invite you over to the agency to introduce you to the directors and give you like a little summary of the department and so forth. But anybody's welcome, right? Many people already had that. But oh shit. Okay.
Thank you, Commissioner. And I'll circle back because I have questions on 183 as well. So questions from the committee, Representative Delnicki.
Thank you, Madam Chair. And good to see you here, Commissioner. My recollection, we had a bill essentially the same as 183 last year. Wasn't there also a cost of software involved, or am I thinking of something else?
That will be more for the fair credit part of it, but not for the CRA.
Okay.
And you're right, you had a bill, and that bill, it also stated that we were going to examine federal banks, which again, you cannot do. I mean, we cannot surpass federal law. And for whatever reason, that bill was in the consent calendar and didn't pass. So
yeah, I was.
This bill is a little different. It's similar in many ways, but it addresses some of the issues we had with federal law.
Yeah, I was going to follow up on 178, the concept of the state charter versus the federal charter, and the fact that, am I correct in this assumption or conclusion that if it's a federally chartered bank that tries to do this kind of operation in Connecticut, we wouldn't have the ability to stop them, or am I wrong?
You're correct. There's a National Banking Act, and basically, charter is a choice, right? So if you're a bank, you can start a bank, you could choose to start to get a federal charter, which means you follow the federal law and in all 50 states and the 5 or 6 territories we have. Or you could choose to be a state charter, which then you're basically headquartered in that particular state, and that particular state, you still got to follow the federal laws, then you got to follow the state laws. And if you're going to do business in another state, you got to go to that state banking commissioner to get permission because you're a state charter.
So that would, am I correct in this? That would supersede the concept of the federal charter? The fact that they're coming into here and they would have to abide by our law?
If you're a federally chartered bank, the federal law applies. And if there's a conflict between federal and state, federal trumps. Like for instance, in the student loan, there was a conflict, right? And when we tried to enforce our state law, we were taken to court. Not only us, but then DC follow us, California follow us, and we actually lost in all 3 districts. When I say we, meaning the industry, right? Because the judge ruled that the National Bank Act supersedes any. So if you're a state charter institution or you get your license from the federal government, states cannot override those rules that the federal Congress passed and say this will be the law.
Good. And a follow-up on 183.
Excuse me, I'm sorry, Representative Delnicki, I apologize. Do you think you can hold that question? You've had your 2, and I'll circle back if you don't mind. All right, thank you very much. No, that's okay. I'll circle back to you, I promise. Senator McCrory.
Thank you, Madam Chair, and good morning, Commissioner. I have a question, and thank you for your very informative answers. So I'm going to try to have my dialogue, real questions, real simple, so a fifth grader understand who don't know anything about banking. I think you mentioned since CRA concept was started in 1977, and you said since 77 there has been 2 changes. Is that correct to the CRA? No, yes or no?
Yes, Mr. Yes, Senator.
Okay, so right, so as we move forward, since 1977, there only been 2 major changes in the CRA Community Investment Act. Then I'm not comfortable or convinced that whatever something might happen with this new administration will happen. So I'm not convinced anything. And what I am convinced is whenever you get a new administration, the rules change, but really nothing has changed only twice since 1977. You mentioned the last time, I think you said it was 2006. So I am very confident that we should move forward with 178 because these 2 bills, Senate Bill 178 and Senate Bill 183, these are consumer bills. And these bills do what needs to be done in the banking community, which is help those who are not bankable or where these banks don't go. So that's my commentary. I support SB 178. I support, SB 178 and SB 183. And I think we need to do a lot bigger dig and fight. And my question for you or my request for you, can you give me the documentation, what banks are required to do on the federal level in our state banks in regards to CRA? How do they get their credits? Can you please pass that information on to the colleagues on this call? Thank you.
Madam Chair, if I can clarify, there's only been 2 changes to the law, and they've been minor. They have not been major. This is the first time we're expecting changes to the statute. And I've been more than happy to send it up.
Right. And since 1970.
Excuse me, there's echo. Senator McCrory, can you mute your mic while the commissioner is speaking? That may help. Thank you.
Okay. I'm just waiting. I'll just wait for the data that we come in. And if there were just minor changes since 1977, that gives me even more reason why we need to do this legislation. Thank you.
And yes, I would be more than happy to provide you different. If you're a small bank, you're examined with the small bank criteria. If you're mid-size, if you're a larger bank, I'll be more than happy to provide that to the entire committee.
Thank you, Senator McCrory and Commissioner. Representative Doucette.
Thank you, Madam Chair. Good morning, Commissioner and Matt. Thank you for coming, and thanks for discussion we had over the last few days leading up to this. I think we've had a good dialogue about these 2 bills, so I don't need to go into it too far. And I know they're like everything, a work in progress. Both of these were under consideration last year, so we began those discussions really at the beginning of last session, and they continue, which is good to have that dialogue and help us to learn how the department functions. Obviously, we are sensitive to staffing issues, especially this year, and we should, I think, talk more about that as the banking committee. And I think with respect to all the agencies across state government, I hope and suspect that the other committees of cognizance will be having those discussions as well, leading into this summer, when I think we will see a lot of those retirements. But with regard to the fair lending, again, being sensitive to the fact, I think a lot of our discussion, and I believe it's section 6 of the bill, talks about the examination procedure. And when we started talking about that last session, that concept looked a little different. And then I think we modified it to say, okay, well, sort of a discretionary procedure that the commissioner would have the ability to invoke that procedure, and that it would basically just sort of follow the federal examinations for fair lending. And then, we talked a little bit about how that would actually look on the ground in terms of staffing. We did, and we discussed this, and I haven't had time to verify, but I believe we did make a modification to the banking fund in the biennial budget last year to account for some increased costs for software and perhaps a new position or 2. But that's buried in the budget somewhere. We did not pass this legislation last year, so the point is moot currently, but something that we should continue to look at. So my question is, without Section 6 or with further modifications to Section 6, do you think this bill stands alone, and it's something that is beneficial to act on this year, even if we don't have, again, a complete sort of a game plan for implementing the procedures that are outlined in Section 6?
Mr. Co-Chair, what I would say is this, that one of the major changes in the statute, well, not one of the major, one of the things that would change dramatically is that it will also apply to a new group of entities, right? Mortgage companies, which personally I think is a great idea. But it's something new that applying to a whole entire new entity, especially one that we've had some issues with enforcement. It's going to take a lot of education, and it's going to take a lot of effort to make sure that they are aware of the requirements and what the expectations are. Because the goal is not to go and lend somebody or find somebody, right? The goal is to impact behavior, right? And to improve access to credit to everybody in Connecticut, and specifically, to low to moderate income individuals, but to be done in a fair, equitable way. There's a lot, and what happens is there's going to be, I expect there'll be a lot of pushback saying we're not a friendly state, we're passing more laws, right? So in order to minimize some of that, there's going to have to be a lot of education, or in particular of the mortgage companies, because this is going to be new to them. For the banks and the credit unions that this will apply to, it'll be minimal because they're familiar with it, and they already are examined primarily by the federal regulators, right? And what we will do is we will mimic the federal regulators' examination process. We might tweak a little bit because every state is unique in some way, but they'll mirror the federal ones 99.99% of the time. And my commitment to the industry, especially those that are already under the requirement of fair credit, is that we will do it jointly with the federal regulators, right? So we will not put extra burden on them by saying, okay, 1 year will be the federal, 1 year will be the state, and then the next year will be the federal again, right? So we will work together like we do with CRAs and what we do with IT examinations, right? Which, there may be a team, and the team is composed of federal regulators and people from my office. And instead of doing it a different time, we do it together. We may have different opinions, and then we work it out as regulators, working with the representatives of the institutions. So, and also it's going to take some time in making sure the consumers understand what this means, right? Because, for instance, some people think the CRA means banks have to, open branches or headquarters in particular areas of the state. That's not what the law requires, right? Or that the law requires that the banks have to make available in credit unions lending to Hispanics or African Americans, or you pick, right? That's not what the law requires. The law requires low to moderate income people, right? So education is very important. So we don't set false hope, or we don't get the feeling saying, you're not doing your job. It's amazing how many times, in fact, this week I got 2 letters, right? People who were complaining. One of them was complaining about the state treasurer, right? And I had to respond back and say, I don't regulate the state treasurer, right? Well, he sends back a letter saying, you take an easy way out. You're not doing your job. The law requires you to do what it is that this person wants me to do, right? And what do? I mean, I don't have the power to tell the state treasurer to do whatever it is this person wants him to do. So it's important that the consumer and the residents of our states are aware what those laws really are intended for, which we all understand, or what those laws are really capable of doing, so we don't set up false hope. Because it's amazing the number, and Matt is the one that would normally handle that. I mean, I see it, I read them, I'm very hands-on type of a commissioner. But it's amazing how sometimes the consumer gets frustrated because they feel that we should be able to help them. And we can't, because the law does not allow it, right? And those are foreign our jurisdiction. Like, for example, and I'm only mentioning this not because I'm thinking that the state treasurer did anything wrong. They asked because that letter came in last Thursday, right? So I've been dealing with that in the last few days, as an example.
Okay. No, I guess my thought and my question really related to the if you break down this bill, there's a procedure in Section 6 which requires the department to set up these examinations, right? But the rest of the bill itself simply codifies existing laws. If federal laws are Equal Credit Opportunity Act, other laws that are primarily housed in our CHRO statutes. So by wrapping those into the banking statutes, it would give you some authority, for example, in the context of a CRA examination, or something like that. So it makes it crystal clear that those laws and regulations apply to the activities of mortgage lending, because they're right in the banking statute. So that's sort of part one of the bill. Part two of the bill is the examination procedure. So what I'm hearing you say is that the examination procedure will take some time to implement. We have to really think smart about how we want to do that. But my question, in my sense, is that Section 1 still has some value to it. And I'm using sections because there's actually 8 or 9 sections in it. But I think what we're talking about is Section, I think, 6 and maybe 7 of the bill. So take a look at that. My sense is, again, that if we are in agreement that we might want to scale back and take some time to think about how we implement that maybe the bill can work without that examination procedure right now, and the understanding that we're going to continue to work on that over the course of the next year, and maybe something we see next session. So just a thought there. And then question number 2, that was all question number 1. Was that? No?
You have to circle back. Sorry.
Okay.
This is that former deputy speaker in me. Sorry, Representative.
Okay.
So I'll circle
All right.
back.
All right.
Representative Delnicki.
Thank you, Madam Chair, and thank you for the uniform application of the rules pertaining to the public hearing. Commissioner, going back to 83, SB 183, do you see any problem with the concept of lawful source of income? Because I'm not quite sure how that is going to be appropriately applied based on variety of state laws versus federal laws.
Representative Delinky, I mean, I've not really put any thought into that, because, top of my head, if it's a lawful source of income, there'll be a 1099, W-2, a pay stub, or something like that will provide that, or some sort of letter if it happens to be like Social Security or some other type of income that will say you get so much every month or every year. But so I don't, top of my head, without really thinking about it, I don't see an issue with it,
Yeah, I noticed that when I read the bill, and I can think of a couple of things that conceivably would be lawful sources of income in Connecticut. The comment was made about what it's going to take and what you're going to be losing in the way of staff, and the fact that it takes 3 years for an auditor and an examiner to reach their full potential. And I realize this doesn't apply to any of the bills per se that we have before us today, but what's the impact of that in the existing laws and regulations that we have? And how's that going to impact anything that we're proposing? And I believe that'll be my 2 questions.
Well, that's the point that I'm trying to make, and I guess not doing a good job at that. I believe both bills are great bills, right? And that both bills should be implemented at some point, right? And my biggest fear is when an agency has power to do something and is not capable of doing it because it can physically do it because it doesn't have the staff, right? Or you have the staff, but you don't have to train people, right? And remember, there is no college degree to be a bank examiner. Nobody goes out the years in school saying, I want to be a bank examiner. In fact, most people don't even know that exists, right? And even if you did, like, I want to be an accountant from day one, right? It seems like, I never thought about bank examiner, right? Because that's not something you're taught. But even if you did want to, there is no school you could go to get a degree or education in bank examiner. That's something you learn through different other majors, whether it's finance, accounting, and actual practice, right? And in order to be able to do joint examinations with the federal government and have the same weight, you have to go to what they call the FDIC schools, and they're 4 schools, right? CRA, for credit, safety and soundness, and IT. Each one of those schools, they average about 6 to 8 weeks. Some are 6 months. So you can't send them to every school one back to back because that's too much data. So you have to send them. So like, for instance, the one that lasts 8 weeks, you send them for 4 weeks, then you send them in the field. You practice what you learned for about 6 months. You do a refresher, and then you go and finish the other 4 weeks, right? And then you send it back to the field and so forth. So yes, part of my issue is that I'm going to have a lot of rookies that are not going to know what to do. And I'm going to have consumers saying, but you're not doing your job. The state legislature passed a law says you must do ABC, and you're not doing ABC. And it's not that we're not doing ABC, so we're not capable of doing it at this point. So I support both bills, but I'm being practical and saying it's the timing. And I don't want to set up false expectation for the consumers or even the legislator, or for you guys to get mad at me someday and say, we gave you the tools and you're not using it. I'm just trying to be honest and practical about it. Trust me, I believe in what you're trying to do. You're the legislators, you make policy, I'll carry it out. But I'm being, like, for instance, co-chair Doucette says that there was some additional money put in the budget and positions. Well, that was the case. I don't know what happened to it because my head count is the same. My bottom dollar amount, the only thing changed by it was raises that were required because of union negotiations. So maybe at some point in some committee it was passed, and I don't know what happens afterwards, but I can tell you the budget I got, the only change was my rent went up and salary increases went up because of union negotiated raises. And I'm not saying that's negative. I'm not trying to make a judgment on that. My head count did not go up at all. And my budget is basically 90% salary, another 5 or 6% rent, and the other one is things like paper clips, pencil, pens, and there is travel for training. And there is travel, like, for instance, we regulate PayPal, right? So we're going to go do the examination, we have to go to California, right? As part of the team that does that. So there's money for travel for examination. But the bulk of my money is salaries and benefits, rent, and my utilities are included in the rent. And then the rest is for those miscellaneous type of things. And that did not change. I mean, the salaries did change, but strictly only due to increases due to pay raises, negotiated pay raises. And I'm not saying that somebody didn't pass it. I'm saying it didn't make it to us.
Well, Representative Doucette did say he had to circle back and look into it. So thank you, Commissioner. Did you have any other questions, Representative Delnecki?
No, I just want to thank the commissioner for his candid comments there pertaining to the challenges you're going to have over the next couple of years with the retirement of a number of your examiners and what it's going to take to just get up to speed for what you currently do versus what we'd like you to do additionally. Again, thank you, Commissioner, for your comments.
Thank you for the questions.
Thank you. Our newest member, Representative Pizzuto.
Listen, thank you for allowing me to ask a question, Commissioner. Is there a firm or a cohort group of people that could be hired, just like when you hire an auditor, that would train people to be bank examiners that would then report to you, but would be, some kind of line item in your budget that would pay for? I gotta believe there's a demand for, especially if there's no specific education cited for that. But again, I'm, forgive my ignorance, that maybe that doesn't exist. But some of these agencies, especially the large firms that are auditors, might be able to put together a cohort group that could specialize in bank examining. Just my 2 cents, Commissioner. Yeah.
To answer your question very directly, yes, every bank, whether you're federally, state charter, mortgage company, debt collector, you name the entity, hire public accountants to do their audits. So of course they have people in their individual firms that know their regulations and know how to examine that, right? But as you all know, the labor market is very tight today, right? We can't even find people for positions that are not, that have such a high requirement, right? In our case, there are educational requirements. Every single one of our positions, except for the clericals and so forth, require college degrees. They require either accounting, finance, business administration, economics, or now more lately, computer sciences, right? Because there's a lot of stuff with cybersecurity. And on top of that requires knowledge of federal law. So now what we've done is we hired a lot of trainings, right? Connecticut career trainings, because we can't find people because there's no college that you could go, there may be like an intro course that says government 101, right? But there's no college you could go and get a degree in bank regulation, right? So you have to learn that on the job, right? And those people who work in those accounting firms, I mean, look, I took a major pay cut to take this position, right? So I could make a lot more money in the private world, right? So most people are not going to leave the private world to come into government at a pay cut, right? At my level, that's true. At the seminars level, that's not as true, right? But it's still true to some extent. And even if we could, the accounting firms are having problems hiring people, right? Everybody's having problems hiring people. Even though, to be totally honest with you, when we do post clerical and trainings positions, we do get a lot of people applying, right? So we do get a good portion because people still want to be employees. And with our luck, for the most part, we get to keep those people. Even though recently, I already lost a couple of the new people we hired last year. One, because he went back to college, right? Another one, because we do a lot of task force with the IRS, FBI, and some other agencies with 3 initials. And one of them went to work for the IRS. So that I don't see as a loss. And even the one that decided to go back to college and get a master's in cybersecurity/IT, that's not a loss. But, he was with us for a year and a half. We spent a lot of time in training, and then he got this opportunity for this, got a scholarship for this new degree that UConn is offering around, IT, and can do both. He couldn't do both. So the labor market is very tough right now. And I, I still have a couple of people in my office that have been there for 40 years. And they have not decided to retire yet. They started right out of, college when they were 21.
Thank you, Commissioner. Representative Pizzuto, did you have another question, sir?
I'm all set, Senator. Thank you.
All right, thank you. And to my co-chair, Representative Doucette.
Thank you, Senator Miller. I just wanted to touch before we let you go, Commissioner, on the CRA bill as well. The thought there were 2 things. I think as Senator McCrory touched on, as we talked about CRA last year as well. I think the thought was that we certainly need to do better, and while we appreciate that it's a federal law, I think it behooves us to educate ourselves on how we can improve the process here in Connecticut. And I say that because our own research showed that there are a few very limited examples of how the Connecticut CRA differs from the federal CRA. And while I understand it's a balancing act, we want to be sensitive about that. We don't certainly want to, do something that's dramatically different here in Connecticut, and then, create a great deal of confusion and perhaps even unfairness for our state regulated institutions. I think the thought was that we want to better understand how it works here in Connecticut. And if we do have the ability to make some modifications that would be reasonable, that we would have the ability to consider that. So I guess the question is, do you agree that we do have the ability to modify it? And I'm looking for my research as to where specifically, and we probably don't need to get into that. But I guess the question is, do Is it your opinion that we shouldn't even consider modifications, or that the modifications that maybe we do have are not significant, and we don't need to consider going there? What's your thought process on that?
My thought process is that the current statutes that we have are adequate, and even the slight modifications are reasonable. People understand them, and we can debate whether we think they're working or not, but we enforcing them, right? My concern is that if you put a group together, and let's assume they come out with 2 or 3 other modifications, whatever they may be, right? But if the new federal law doesn't allow it, or they take jurisdiction over it, we have wasted a lot of time and energy, right? And set up hope, and people will get frustrated with that, right? So I think the idea of looking at our statutes periodically is a great idea, no matter whether it's banking, whether it's, you name it, right? You should look, it's like procedures, right? You should look at them, just make sure that it's still applicable and it makes sense, and that's way to apply it, right? In this case, all I'm saying is the timing. Now, the criticism that we talked about this last year, there's a new administration, it's good, it's legitimate, it's a true criticism. But the difference is, remember last year when we were talking about this, the new administration, the new president only been president for about 2 months. And of course, this is meant more as a joke than not. And every time I try to make a joke, I get in trouble, so I probably shouldn't do it. But they were still trying to figure out what the bathroom was, right? You know, now they have already set up a person to head the CFPB. They were not successful, their candidate for office of the controller, but they have a deputy that has a different philosophy than the one that was there before. They have made all the nominations, and they're in the process of getting confirmed for the Federal Reserve. And all those come from a point of view, whether you agree with it or not, the fact is, they come from a point of view, they're going to be more pro-consumer and more to be able to enforce laws that are going to make credit available to low to moderate income and everybody in general, but specifically low to moderate income. So what I expect to come out in climate change for the first time will be part of that, right? In fact, when I testify in writing, so this is a document that's available, you know, one of my recommendations is that when we change the law, we should give credits to institutions that CRA is applied to, that does lending to entities that do climate change, whether it's, you know, solar panels, whether it's electric cars. Not that you require it, but if you do it, that's clear that that's one of the things that you would get points towards passing your CRA, right? So in other words, using the carrot approach. Now, if they don't pass that, right, I would not be able to do that. Now, can we say in Connecticut that at least for state charter institutions in Connecticut, if you do it, you get those points to pass the state? Okay, but if you don't pass the federal, the state doesn't matter, right? Because the federal is going to supersede that. And that's what I'm trying to say. And what I'm really trying to do, at my level, what I get is a lot of frustrated people saying, the law's not fair. This law that you passed, like if I pass laws, I don't pass laws. Basically, let's pass the laws, right? You're not doing your job. You're only saying it's not in your jurisdiction because you're lazy, right? You know, I see that firsthand, right? And I see the frustration, and I understand why people feel that way, right? Because of misunderstanding, and they themselves don't understand what the law really is giving them the power to do or not. Now, you may hear testimony today from other people saying that we're too tough, right? From the other side, right? And that's too many laws. Again, that's a judgment call you guys have to make. I'm not going to get into that, you know? All I can tell you is, based on the 2 laws that you're proposing, and the one change that we're proposing, I think they're fair, they're equitable, they should be supported. My question is timing and practicality. And I truly believe that it'd be different this year because you now have an administration that's going to give this first State of the Union address, right? You have an administration that's been there a year. You got to give people a chance to walk, right?
Yeah. No, understood. But, you know, I think the interest of the committee is that is in the issue of fairness and those low to moderate income consumers. And if CRA is the vehicle in which we try to regulate that, and to make sure that all of our financial institutions are being, good citizens, and that everyone has equitable access to banking services, then CRA is part of the discussion. So it's complicated. I appreciate that.
And also remind the committee. I'm sorry.
No, but and that's it. I understand. I appreciate it's complicated, and I think I appreciate your points and the complexity of the issue, but I look forward to continuing the discussion.
And also remind the committee this is a mistake that Congress also makes, in my opinion. In particular, Senator Warren, is that most of these complaints, right? Most of these issues really come from the big boys, right? What I call the big boys, the big five banks, right? Wells Fargo, Bank of America, Chase, and I'm forgetting about the two for right now. But nothing you pass is going to impact it, right? So you may want to pass something to try to address an issue that our local banks, our local state charter banks don't have, right? But now you're going to put this extra burden on them and not get anything out of it, right? And that's why it's important to understand what the law is, what you can do now, and what the law may look like. So, it's been in the news with Chase, about they started to do the robo signing again for collections, right? Well, you could pass a law about that. I can tell you none of my state charter banks are doing that, or state charter credit union. We will not allow it because we have other ways to address that, and nothing you do today or tomorrow is going to change if Chase can do that or not at this level, right? We can influence it at the federal level. Or what happened with Wells Fargo, with the opening accounts and the credit cards that people started showing up in the credit report without them signing. I can tell you my financial institutions are not doing that, and we will catch that and we will address it. We'll figure out a way to address it on the safety standards because of that, under the pretext that they will get sued and they could, lose the capital and that kind of stuff.
Excuse me, Commissioner.
Thank you.
We appreciate your testimony. And before you leave, I wanted to make a couple comments.
Yeah.
I believe in education. I believe in people being informed, and you stress that throughout your testimony. My question to you is, do you have a system in place that educates the public currently?
Yes, we have a staff person that works directly for Matt, and we do a lot of outreach in the community ourselves. And in addition to that, all state charter financial institutions are required to have a program in place as part of their CRA to do literacy education. Now, to be honest with you, I'm not going to name cities, right? When a lot of those programs are available, the ones that really go out of their way to do it are the ones who probably need it the least because they already have something in their towns that are addressing that, right? So, like for instance, one of the things we do to educate seniors is we have this thing called bingo, right? Financial bingo, right? And we may say, B1, right? And then B, and we come out with a topic. If you get a phone call saying that your grandson has been arrested, what you should do, right? You get your bank statements, should you bounce, right? So we engage the people. So that's one way we do it, right? Another way we do it, we do the classroom type of style, right? Where people sit there and one of our people goes there and starts teaching about this budgeting, blah, 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 right? Also, we did put together a working group, which is made up of bankers, credit union, and other citizens and advocacy, because there's so many different programs out there, but they're not coordinated, right? And they're all over the place. And I'm expecting, and they are working on a request for qualification. And this has been funded through a contribution that several entities made to the department for that purpose, right? So in the near future, we expect that we will have an entity that was going to work with the different banks, credit unions, and other people to come up with a more comprehensive, coordinated effort where everybody's given the same message. In other words, develop a curriculum that is across the board.
So, Commissioner, excuse me, sir.
Yep.
So the point I would like to make is that COVID has impacted us in ways that we couldn't even imagine. and we can't do business as we did in the past, right? And we have to find new ways of doing business. So I understand you when you say that the public needs to be educated. I understand when the public says you need to do your job and the public don't understand exactly what the law may be. But what I'm asking you to do is to consider ways of making sure that we can pass our policy and you educate the public at the same time, because I think we can't wait to see educate and then implement policy. You know, I have a new model now. If not now, when? And that's what, you know, that's what COVID has done to me, is that I can't wait for tomorrow, because we were waiting for tomorrow and then we had Omicron, right? So we really have to think about things that we can do to protect the public, and especially those families that are low and moderate income. And so I understand what you're saying about education. I understand what you're saying about staffing, and we're going to work with you. We want to partner with you. But at the same time, we cannot let our people suffer, right? Against bad players, for instance, like the loophole that you had mentioned earlier about the state. Those are the kind of things that we need to think about, and how do we protect our people in this state? And so I know we're expecting a great exodus come July, as my co-chair mentioned. And so thinking about how do you do that? How do you, stop that bleeding? And so I'm just asking you to consider our policies. What about these two bills that we can do without pressuring you and putting so much pressure on your staff, I should say. And I really do appreciate your testimony. I appreciate what Matt has done coming before the committee and explaining the bills to us. And again, when you say my banks, I appreciate that, because that means that you take it personally, the work that you do for the banks, and that you make sure that the banks are not taking advantage of the people and doing what they're supposed to do to make sure that the constituents of this state are protected. So again, I thank you for your testimony and the information that both you and Matt have presented to us today.
I thank you all for the opportunity to speak and the questions. And I just want to assure you, I'm an ally. I believe in what you're doing. I think those two bills are good and they should pass. I just want to be real honest and be very practical about it. So please do not take any of my comments to mean that I don't think that what you're trying to do does not make sense. You know, I was raised by a single mom, welfare, Section A, first one in my family to go to college. I understand all that stuff. So I feel and I understand what you're saying, Madam Chair. And I fully understand it from now on, right? But I also want to be practical, and that one of the worst things you could do is set up false hope, right? You know, you want to keep hope alive, but
yeah, no, I agree with you. And so I don't want to belabor the point. I appreciate, and I wasn't saying that you were against, because you said several times that I'm for these two bills, but I just want to be practical. I'm just asking, let's sit down and be partners on this and see what we can move in these two bills. So
and again, I can tell you, since I've been commissioner, we have increased efficiencies and productivity without staffing. And we even, for the first time in the history of the agency, have been accredited in the three major areas that we examined, which means you have to meet particular standards. And that was done without any major increases in staffing. It was done through IT, training, so on and so on.
Well, Commissioner Perez, I can only say one thing about you, that I've heard great things about you since you've been commissioner. So, and that's why I'm asking you to look at the two bills.
Well, you have my commitment.
So thank you very much. I appreciate that. And thank you, Matt. Appreciate you being here today.
Chair Miller, it's great.
Okay.
Always
All right.
a pleasure.
Thank you. So we've gone beyond the hour, and so we're going to go to our public list now. And after the public list, the next person on the public list, we'll have Representative Vargas speak. So the first person is it Tori or Michael, Dawn?
It's Tori.
Tori Hamilton.
1 second, we just have to promote her.
Okay, thank you.
She's connected now, Pat.
Thank you. Good morning, Tori. Thank you for joining us this morning.
Good morning. Thank you for having me.
Okay, you have the floor, madam.
Thank you so much. Good morning, everyone. My name is Tori Hamilton, and I'm the Bank on Connecticut Program Manager with the Connecticut Association for Human Services. And as the Bank on Connecticut Program Manager, I'm here to provide testimony on HB 5216, an act concerning low-cost bank accounts. And I thank the Banking Committee for allowing me time to speak today. Bank on Connecticut is part of the Bank on National movement that connects our unbanked and underbanked citizens to safe, affordable, certified checking accounts offered by our financial institution partners. To become certified and a part of this movement, financial institutions agree to offer a checking account that has minimal fees, lower deposit requirements, but the caveat is no overdrafts. The Bank on Connecticut Coalition is making a concerted effort to disrupt the negative connotation associated with the banking institution today. According to most recent data shared by the FDIC, Americans have a distrust of banks. They don't understand the fee structures, cannot afford to maintain an account due to exorbitant deposit requirements and fees on top of fees. But most importantly, they don't feel that financial institutions understand or care about their own or their community's needs. In Connecticut, 8% of our residents are not a part of the financial mainstream. That means that they're utilizing expensive fringe financial services and lack the financial literacy sorely needed in low wealth communities. When you factor in the Hispanic population, these numbers double. The lack of an adequate financial and digital infrastructure leaves many families without the ability to access basic and dependable financial services. The pandemic and blaring race and wealth inequities that exist in our state have exaggerated this fact. During these unprecedented times we are facing, one overdraft could literally mean that a family goes without groceries for the rest of the week. Think about that. Bank On is in full support of the passage of HB 5216 and strongly encourage financial institutions across the state to consider partnering with Bank On Connecticut. Thank you for your time and consideration, and I am available for questions.
Thank you, Tori. Are there questions from the committee? Representative Doucette.
Thank you, Madam Chair. And hello, Tori. Thanks for joining us today. And thank you for all the great work you're doing with Bank On. We learned about Bank On, I think, first last year, or at least I did. And in the context of the question of, you know, what can we really do to make an impact on the devastation, as I think you detailed, that you know, overdraft fees can have on low to moderate income folks. And you guys do a lot of great work, as you detailed, in financial education as well, which is great. So a lot of great things going on, I think, that you highlighted. Question, I wanted to give you an opportunity to talk a little bit about what's sort of happening in the marketplace right now, both with respect to the trends that we're seeing with the largest banking institutions modifying or changing or dropping overdraft fees and creating more streamlined accounts like this, number one. And then number two, if you could talk a little bit about what's actually happening in Connecticut, which institutions or how many institutions you have currently signed on with Bank On, and how the program works with those. I know there's little differences between the ways that different banks administer their Bank On products, but that's all sort of permitted on the under your standards. So two questions in there. One, sort of what's happening nationally and what you see happening in the industry, and number two, what's actually happening with Bank On in Connecticut. Those are my two questions, Madam Chair.
Thank you, Representative Doucette. Great questions. So nationally, we're seeing, I do think the pandemic has turned obstacles into opportunity, because banks are now understanding, people are not flooding their waiting rooms any longer, right? And so they have to look at different ways to reach communities that have not been part of the financial mainstream before. So I think the American Bankers Association, during their convention last year, made a plea that banks, in their coffers, consider joining Bank On, consider during the pandemic just relaxing some of these fees and some of the requirements that banks have traditionally allowed. Okay, so that has happened. In Connecticut, we're seeing community groups connecting with our banks and working together to get the financial education to the communities that need it the most, right? And I think that's really great. In addition, the banks that are part of, and credit unions, the financial institutions that are part of the Bank On Connecticut, are going a step beyond. They're providing credit rebuilding opportunities for the low to moderate income communities that they serve. They're also, like I said, connecting with community groups to deliver financial education and promote these great accounts. When I started with Bank On in 2 weeks before the pandemic hit, we had 4 banks that were part of the coalition. The 4 national banks: KeyBank, Bank of America, Wells Fargo, and Chase. Today, we have 13 members and more expected by the end of first quarter. And this is a combination of community banks, state chartered banks, and we also have a credit union that is offering a digital product to actually compete with the fintech companies like Chime. They're offering an all digital product in Spanish as well as in English. So there's lots of different moving pieces going on, and it's really exciting to see happen.
No, that's great. And I think, that shows how fast it's growing and how it's becoming, part of a trend really in the industry, both in Connecticut and nationally, like you said. So I think the time is right for us to really look at this. Thank you, Tori.
Thank you.
Thank you, Representative. Are there any other questions from the members on the committee? No? Okay, seeing none. Tori, thank you so much for bringing this issue to the committee and testifying before us today.
Thank you for having
Bye-bye.
me. Have a wonderful day.
You too. Our next speaker will be Representative Vargas.
Thank you very much. Good morning to all. Especially like to thank the co-chairs of the Banks Committee, Senator Miller and Representative Doucette, and ranking members and all the members of the Banking Committee for an opportunity to speak today. I am supporting a bill. I'm co-sponsoring a bill, Senate Bill 180, together with my Republican colleague, Representative Tom Belnicki, and many others. It's a bipartisan bill that seeks to reduce the interest rate on outstanding liens against properties. Right now, the interest rate is currently 18% compounded monthly. And this is having a very negative effect, especially on people with fixed incomes, low income. Many times people inherit properties that are highly valued. And unfortunately, once they get behind that 18% compounded monthly, makes it very difficult for people to dig themselves out of the hole. So I am encouraging the committee to support this bill, Senate Bill 180, which would reduce it to from 18% compounded monthly to 12% annual. I think we can all agree 18% compounded monthly is a usurious rate, and we, as a society, we've been against usury we've been against profiteering, and it's just something that is affecting not only urban areas, it's also affecting suburban and rural areas. I was talking to Representative Wilson, also from the other side of the aisle, who had a family owned farm for generations. The family had owned the farm and they found themselves in a similar situation. And so I was contacted last year. I introduced this bill, but at that time I was seeking to make it the cost of living as determined by the Consumer Price Index, National Consumer Price Index. And I was contacted by a group of tax collectors who said that would just be too low, wouldn't put sufficient incentive on people to pay their back taxes. So we agreed upon 12% per year as being fair to the towns, but also making sure that those outside mills, lien mills that sometimes buy these liens, don't use them to basically force people out of their homes and later auction off their properties, which unfortunately is happening all too often. There's another idea that I hope, at some point we can, the banking committee can look at, that I've been proposing, and that is that before a lien is placed on a property, that advance notice and an opportunity for a hearing take place. I think that's just a fair process, and gives people, due process to protect their property. Perhaps with a hearing and due notice, they might be able to resolve this at the lowest possible level without getting into a situation where they fall behind. And many times, one of the things I've heard is from people in this situation is many times months and months go by before people are alerted to the fact that they have a lien on their property, either because the mail goes to a wrong address or to the wrong individual. And by the time they figure this whole thing out, it becomes very difficult for them to dig themselves out of the hole. So I'm hoping the committee will join favorably, send this bill SB 180 to the floor of the House and the floor of the Senate so we can approve it and send it to the governor's office. Thank you very much to the leadership and the members of the committee. And if there's any questions, I'd be happy to address them.
Thank you, Representative Vargas. Are there questions from the members? Representative Delnicki.
Thank you, Madam Chair, and I want to thank my friend and colleague, Representative Vargas, for coming forward today to testify on this issue, because quite frankly, this issue touches all people in Connecticut, whether you're living in a city, a suburb, or in a rural community. This is a huge issue. I want to ask you a question. Last year, we had testimony from the Connecticut Bankers Association, and they actually stated that they thought 6% was appropriate, which kind of surprised me. But quite frankly, if you look at what the rates are today, Webster on a HELOC is under 4%, and personal loans about 8%, and mortgages about 2.9. What do you think about their initial proposal last year? Not that I'm encouraging this year versus the proposal we have this year.
Thank you very much for that question, Representative Delnicki. When I originally proposed last year that the back taxes only, the only interest on the back taxes would be whatever the percentage of inflation was determined by the national CPI. I was contacted by a group of tax collectors, and I believe their position was that yes, they agreed that the 6%, probably was fair. However, they felt that the only way to really pressure people, and that's one of the reasons they opposed my my rate of inflation proposal, is that inflation at that time was only running 2 to 3% a year. And they felt that was not going to put sufficient pressure on delinquent tax rates. So it's a balancing act, because there's many people that are targeted unfairly and that are in a difficult position, but there are other people that are frankly tax delinquent. So the balance was to increase the pressure. I think now that inflation, last time I looked at it, was about 9%. The 12% covers that, and at the same time creates that pressure that they need to make sure that people are on top of their taxes. So, I would love to lower it, to the lowest possible to protect those people that are on fixed income, retirees, and others that maybe depending on Social Security or small pension to survive. So I agree with you, Representative Nikki. But on the other hand, the political reality is we want the support of our tax collectors, and we want to make sure that we protect the municipalities too.
So then, in your opinion, we know the 18% is roughly what the average percentage rate is on credit cards today. So basically, you see this as a reasonable and equitable compromise on what is a huge interest rate charge currently by the cities and towns, and when they assign to a third party, the third party then has that same percentage rate. So it's a reasonable compromise to both address the cities and towns and to address the individual taxpayer.
That's correct. I believe that we have to find that balance, the appropriate balance. 12% has the support of the tax collectors. 12% would be a huge improvement over that 18% compounded monthly. That is something that when people hear that, they can't believe that that's happening to them. I've talked to so many people in very painful situations because after time has gone by, month after month, when people finally realize they're in the hole, it makes it very difficult. If you think you owe, $5,000 in back taxes, and then all of a sudden you discover that the 5,000 has become 50,000, it's and it puts your home at jeopardy. It's after people have paid off a mortgage, people have been working hard. I'm especially thinking about our elderly residents that just don't. They're no longer in their prime earning years, and they're trying to hang on to the properties. So, as a citizen of the state of Connecticut, you work hard, go through a 30-year mortgage, you finally own your property, and to find yourself in a situation where it may just be auctioned off for pennies on the dollar to who knows who, put out on the street. It's a horrible situation.
I thank you for your testimony today, and abiding by the two-question rule, I thank the chair.
I don't think the committee members like my two-question rule. Are there any other questions by the committee members? Seeing none, Representative, I'm sorry, Representative Gucker. Sorry, I didn't see your hand.
Thank you, Madam Chair. I know I kind of blend into the background here in my staying warm in my cool house today. Thank you, Representative Vargas, for bringing this forward. I wanted to ask basically one question. I've had some constituents that have fallen into this very same problem and issue, to where we've had to go through fair housing and fair lending to try to help them out of this problem, because before they realize that this is happening to them, they're going into a foreclosure and losing their house. Have you seen or have you heard of, once these tax bills become delinquent and they're passed on to a collection agency, so to speak, the ones that assume these loans, have you heard or have you seen of them not really being very timely on notifications, to where they kind of wait till those charges get pretty high before they start to come in?
Unfortunately, these outside companies or corporations that make a living off of buying these liens have no incentive to notify you, because at 18% compounded every month that goes by is it's a cash cow. So yes, you're correct. One of the complaints people have is that months and months go by and they're not aware, and all of a sudden they become aware, and because the town lets them know or whatever, when they go to the town to try to resolve the situation, they're told by the town tax collector that they cannot pay because the town no longer owns the lien. And when they ask, well, who owns the lien? They say, well, we sold the lien and the company paid, let's say it was $5,000. The company paid the $5,000, so the town no longer has the lien. So you go running to the company and you ask the company, well, what can I do? And they say, well, we've farmed that out to a group of attorneys, attorney law firm that specializes in collecting these back taxes. And let's say it's Smith and Smith, so you contact the law firm, and the law firm will say, oh yes, we do have your lien here. What's your address? 123 Main Street. Okay, yes, we have it. Give us, $60,000, $75,000 and we'll settle it. He said, well, wait a second. I thought it was 5,000 from what I was told by my municipal tax collector. He says, well, you have to understand, Mr. Jones or Mrs. Jones, that, several months have gone by, the compounded interest, we have to put in legal fees, this, that, there's fines, there's all kinds of other charges that have been added on to this. And, so all of a sudden the person from what was, I'm not minimizing the fact that they may have owed property taxes, but all of a sudden it just increases exponentially and puts the person in a very bad position. So these companies, yes, they do have an incentive, and obviously it's a win-win, because if months go by, the amount you owe is growing, so they make windfall profit. And if you don't pay, they can sell your property on the auction block. And so either way, it's a win-win, because they'll buy it for pennies on the dollar, or you'll pay an astronomical fee. So, I mean, it's a great business model for the people involved, although I wonder about the ethics of it and the morality of it.
So if I could, I fibbed. I have just one other question. So I'll use my second question now, Madam Chair. So if these loans are being or sold off to a third party, really, what is the incentive by the tax collectors then to say we need a certain percentage if they're being sold off?
Well, if, like, for example, in my city, the town of Hartford, we had this issue. And finally, we convinced the city council and the mayor to support a resolution stopping the sales to these outside companies. So there are some towns that do not farm this out. And the 12% is a way to make sure that there's enough pressure on delinquent taxpayers to keep up with their taxes. Because 12% is still a pretty high interest rate, but it's a flat interest rate per annum under the bill, Senate Bill 180. So the pressure is still on to pay, but it allows you to be able to dig yourself out of a hole. Remember, it's not 12% till a year has gone by. So if 3 or 4 months later you're able to resolve this, it might only add a minimal amount to your back taxes. So that's the difference. My own, if I had my own druthers, I'd rather that we not sell liens than that we take the position City of Hartford has taken, not to sell these liens out, because the city has a different view. The city wants to preserve its citizens, wants to protect its residents, it wants to collect its taxes, but it also wants to be fair and not put people out of their homes. There's no such incentives for these outside groups. These outside groups just see numbers, and there's no connection between them and the residents of the municipality. So it's a very different situation when you're dealing with them. That's one of the reasons I like people to have notice before a lien is placed on their property, that they are notified, perhaps by a sheriff that actually puts it in their hands, that at least be 30 to 60 days before the lien goes into effect, so that people have a chance to scramble and maybe talk to relatives, do whatever they need to do to resolve the situation at the lowest possible level before this thing keeps on growing.
Well, thank you, Representative. That's all my questions. Thank you, Madam Chair, for the opportunity.
Thank you, Representative Gucker. Before I get to you, Representative Bohr, I have a question to ask you, Representative Vargas. Would you object to notification being placed in this particular bill?
If an amendment can be made to this bill that would allow for notification prior to the placement of a lien, that would be wonderful.
Okay.
That would be wonderful.
All right, thank you for that. Representative Bohr.
Yes, thank you, Madam Chairwoman. I just want to thank you, Representative Vargas. You've been fighting this fight for a few years, and it's an important issue. These are folks that are having difficulty paying. So to have an extraordinary amount tacked onto that, inherently, they will probably not be able to pay it. So we do want people to pay their taxes, of course. Some of these cities are selling the liens for a quick budget fix. I've had constituents, the liens were sold and they just can't get a hold of anybody, and they can't pay if they wanted to, and they've lost their home. So really, this is an important issue, and I look forward to hearing how we're going to continue to work on the bills notification, because I think that's important as well. Thank you.
Thank you, Representative Boer, and thank you, Senator Miller, for the suggestion on perhaps adding that notification to the bill. And thank all of you. I think that, this is a bipartisan issue. It affects everybody, regardless of their party affiliation or no party affiliation. So and like I said earlier, to the earlier question posed by Representative Gucker, the towns have a very different view on this. They want stability. They want to protect their residents. After all, those are their constituents. But, once this thing moves into a profit mode, the incentives are completely different.
So thank you. I was just notified that we do have notification provisions that was worked on, that was passed last year.
Wonderful.
So, yep. So that piece is taken care of. And so thank you. Representative Paolillo.
Good morning. Thank you, Madam Chair. Thank you for the opportunity to ask the question. And Representative Vargas, thank you for bringing this forward because it affects all of our constituents and our neighbors throughout the state. So one question you mentioned in your discussions with tax collectors, in their work, once a property tax bill is overdue, was there much feedback in terms of tax collectors engaging with our constituents, with residents of towns and municipalities on payment plans, on having that formal outreach or having some type of outreach before you get to this next level of having a file transferred, of having another firm take the file, of having the firm buying these files and then working on it from there? What has been the feedback from the different tax collectors that you've collaborated with about trying to work this out locally so that folks can engage in a plan and work together with the municipality to have those payment arrangements, but also to avoid some of those fees? So it's a win-win with constituents and with the municipalities that we all live in also.
Well, thank you very much, Representative Paolillo. That's a very important question. And what I have found in my discussions with different towns is that it is very uneven. It's unfortunate, but I found, I'm used to having full-time operations in the city of Hartford, and I'm quite surprised. Then when I contact some towns, they tell me, well, they're only in on Tuesday and Thursday for half a day. It's very, very uneven. And I don't blame people in those situations, because some of these jobs are volunteer jobs in some of the smaller communities. People are overwhelmed. So when you have an outside company, I believe it was Representative Boer that mentioned this earlier, an outside company that comes, don't worry about it. You can balance your budget. If you have 10% of your taxes are delinquent, we'll just pay those taxes for you. So along comes a company, brings out the money, pays it off. Sometimes those municipal officials don't really even know what kind of situation they're putting their city residents or their town residents in. It's a quick fix. It balances the budget because you get all your taxes paid off by ABC Corporation. But now you've turned your citizens over to the tender care of an organization that only has one interest, and that's to maximize profits. And that's the sad situation. So to answer your question, it's very uneven. There are places like Hartford that have realized what's going on and put an end to selling the liens. And there are towns that think that this is a wonderful idea. We get our taxes, we don't have to worry about it, let the company go and collect. But the way some of these collection agencies work is very ruthless. So unlike the town where you might sit down with your first selectman and with your tax assessor and tax collector and talk about things and see if you can come up with a payment plan, there's no such incentive in these foreclosure mills. Their incentive is let it ride for months and months. If you don't do anything about it, that's great, because now the debt will balloon and you'll be over the barrel.
Sure. Well, again, thank you for all of your work on this. Really appreciate you bringing this forward, Madam Chair. Thank you for the opportunity today to pose.
Thank you, Representative. And Representative Vargas, you made a very good point about the town doesn't know who they're selling the liens to. And so maybe what we need to do as policymakers is look at the individuals, regulate that industry, the industry that's purchasing these liens, and look at that. Representative Board made a very good point about people not knowing who their lien has been sold to. So maybe we need to put something in statute to say that, Representative Dorset, if we didn't do that last year. So I think that's what we need to look at is the industry, because I chair the aging committee as well. And we're forever saying that our state is aging. And so this is going to affect more people than we think, the older that we get, right? So I think that it is a industry that we need to look at as policymakers. So thank you. Are there any other questions from the committee? Seeing none, Representative Vargas, thank you and for your work on this. We really appreciate it. And so again, thank you for coming today to testify on the issue.
Thank you very much.
Thank you. Next, we have Michael Porzio, excuse me.
Not showing up at the moment.
Okay.
Maybe we come back.
All right.
Can you hear me?
Michael?
Porcio, can you hear me?
Oh,
Yes, Louis
Yes.
Roman?
Can you
yeah,
hear me?
we'll sign you in as the right person.
Hello?
Yes, we can hear you.
You can hear Michael Porcio?
Yes, we can, Mr. Porcio.
Thank you. Thank you, Senator Miller. I am a senior citizen in the state of Connecticut, and so I am particularly interested in these tax liens on the properties. And I first of all, I want to thank Republican Representative Vargas for his work on this. And I think the most important thing would be not only the rate. 12% is very high, but it's already an improvement over the 18% rate. But more than that, I think that all the cities, towns in the state of Connecticut should categorically abolish selling these tax liens to foreclosure mills or corrupt entities who are trying to take advantage of an older person who probably is not even aware that there is a lien on the property, and use that as an opportunity to steal a house. This is akin to a criminal enterprise, and it should be stopped. It should not be allowed, and everything possible should be done to stop the sales to enterprises that do this for profit. Also, they should not have the authority to foreclose on anything, because I think this is even unconstitutional to have some enterprise that has nothing to do with the government to decide to foreclose on your property with a minimal tax lien. They go foreclose on a house that is worth several $100,000. That's totally unconscionable, and it should be stopped. That's one. Number two, I would like to touch on HB 5219, which is a revision of the banking statutes. I would like to know what is this legislation doing on the modification, for instance, of 4915, is CGS 4915, which is completely unconstitutional, and it gives the right to banks to commit the fraud to an extent that I could write an encyclopedia on it, and I can give a case. So can somebody tell me about that too?
You're here to testify, sir. Can you continue, please?
Yes, okay. So now I think I have finished with regard to the tax liens and the interest rates. Now, regarding statutes, there is a statute which is called 4915. CGS 4915 that gives the banks and foreclosure attorney a license to steal and to take properties unconscionably from innocent homeowners. And the way it happens is this, okay? First of all, there are a lot of foreclosure mills that come to court stating that they represent the bank so-and-so. And usually they claim to represent a trust. So under the excuse of representing, let's say, Deutsche Bank, Baba as trustee for somebody. Or
Mr.
HS
Porzio, can you wrap it up, please? Sorry.
What I am wrapping it up is this.
Okay, thank
That-
you.
that
I'm not
49
trying to be rude. Thank you.
Okay, 4915 should be reviewed because it's unconstitutional.
Okay, all right.
Okay.
Well, are
Yeah,
you finished?
yes.
Okay. All right. Well, thank you for your testimony. Are there questions from the members? Okay, Mr. Porzio, I don't see questions from the members. Thank you again for your testimony and waiting to testify today.
Thank you.
Next, we have Senator Kelly. Is he here, Dawn?
Not that we know of. I've been texting with him, and supposedly he's set, but
Okay.
we skip him for now.
All right, thank you. Louis Roman? Mr. Roman, you have the floor, sir.
Yes, ma'am. Good morning, Senator, Madam Chairman, and members of the committee. I welcome the opportunity to testify in support of the Statute 180, and I thank absolutely graciously and with great respect for Representative Vargas. He's been our champion. He stood by us all, and he's brought this abusive process and the stealing of our homes. For the record, I'm a senior citizen, and I am the president of the Pro Se Group, which is a group of people that helped each other with information and research in trying to save our homes from foreclosure. What we've encountered is exactly what Representative Vargas brought to your attention, but there is a cottage industry comprised of law firms that specialize in taking these tax liens by virtue of their inside track connections within the municipalities. This is public corruption. It is, and specifically in Bridgeport, we have one law firm, the Epstein law firm, who has bragged that they own 6,500 units of housing. The principal, Judah J. Epstein himself, bought a condominium in Florida for $6 million in cash. Now he has one client, and that's the city of Bridgeport. He does nothing. He's an outside law firm, but he does nothing but these property tax and WPCA tax liens. So he's able to buy properties for the tax liens. And he has, we would appreciate your support in advocating for an investigation of these charges. I have adequate information, and I want to thank the commissioner, also the banking commissioner, because he's been very cooperative, and we know that he has made himself available to us, and he has cooperated with us, but he's limited as to what he can do, even though there are rules within the state legislature that allow it. For the record, there is something called the Connecticut State Statute 12-181 that says only municipalities can charge legal fees. And that is being abused, and it's also being ignored. There was a recent federal court ruling by Chief Judge Janice Hall on a case called the Weldon versus MTAC, and where she ruled that property tax lien assignments by a municipality, which is a sovereign entity, does not apply to property taxes. And she said that also that property taxes are not debts because there's no lender and no borrower. And it's a service provided by the municipality, which is a sovereign entity. and that sovereign entity status cannot be transferred to a non-interested third-party debt collector.
Can
Madam,
you wrap it up, please, Mr. Roman?
yes, ma'am. I want to thank the committee for taking this into consideration and for your cooperation. And thank you, Commissioner Perez and Representative Vargas. He has been our champion.
Thank you, Mr. Roman, for your testimony.
Thank you.
Questions from the committee? Representative Doucette.
Thank you, Madam Chair. Thank you, Mr. Roman. Did you submit written testimony today? I'm particularly interested in some of the cases that you cited.
No, sir, but I can. I can get it to your attention. I'll work with Representative Vargas to make sure that you get this.
Yeah, would be interested to see that. And then second question is, I just wanted to make sure that you were aware, because it's the first time hearing your name, but of Public Act 21-143, a bill we passed last year. I believe the bill number was Senate Bill 941, which was a pretty major change to kind of the rules of the road with these tax lien assignments. We worked pretty hard on that, and I think it sets some good framework. But certainly, happy to entertain other modifications of that. So I just want to make sure you're aware of that, and if you have any thoughts or opinions on that and how we might improve that.
Yes, sir. As a matter of fact, I'm very familiar with it. As I said, I've been working very closely with Representative Vargas. So he brought this to my attention when it was first introduced to the House, and eventually in October went into effect. The problem with 941, and I've had discussions with Commissioner Perez regarding 941, and it basically has no teeth. There is no enforcement clause. There are no consequences for people, for law firms owning properties, because in the case of the Epstein law firm out of Bridgeport, they are representing that they are a third-party debt collector using shell corporations. I mean, this is about as classic as you can get. I mean, you want to talk about Harvard case study? This is it for public corruption. And everything from the inside operator to even a couple of judges that are pretty much extremely cooperative. And I'm being kind with these folks. We have an incredible battle going on, and the target is always senior citizens who have no mortgages on their property. They have no mortgages. All it is, all of a sudden, they think that they're able to live the rest of their lives in peace, and somebody comes along and buys a $2,000 tax lien, which, by the way, they didn't even know existed, and then that materializes into $75,000. Now, somebody made a reference to the fact that that there should be notification for payment. There were cases that people went to the clerk's office with certified funds to pay, and they were referred back to the Epstein law firm and said, and then the Epstein law firm said, no, we don't want your money. We won't take it because they own it. Sir, you have no idea the extent of the corruption here. And unfortunately, it all affects senior citizens. This is a collusion. This is a conspiracy, and it is provable. This is not hearsay. I'm very detailed on this. I'm a banker. I spent 45 years as a vice president for a bank, and now I run an offshore international bank. So trust me, I know what I'm talking about. And again, we need your cooperation. We would be absolutely thrilled to assist you and provide you with the evidence. Mr. Porcio is part of our group, and we all work together. But it is important that you know the facts, and please, I will be happy to give you that information. Like I said, I'll work with Representative Vargas to make sure you get it.
Yeah, please do. Would be interested to hear that, and again, know what else we can do. Obviously, the work is always evolving. So, but yeah, but that would be extremely helpful. Thank you.
Thank you, sir.
Thank you very much. Are there any other questions from the committee? Seeing none, Mr. Roman, thank you for your testimony.
Thank you, Senator.
For those of you that may have just joined us a little later, the members have been asked to limit their questions to 2, so that other members may have an opportunity to ask questions regarding the testimony, and then I will circle back to members if they have further questions. All right, thank you. The next person on our list today is David Falve. David, I know I saw your name earlier. There you are.
Can you hear me?
Yes, I can.
Oh, great.
David, I must make you aware that you have 3 minutes, sir, to speak. Thank you.
Thank you very much. I'll be careful of that. I'm Dave Falvey. I'm a consumer bankruptcy attorney, and I've had 40 years experience as a specialist in consumer bankruptcy. I'm from Groton, Connecticut. I'm here to speak about House Bill 5218, credit card access to home equity lines of credit. I can tell you from many clients that they do not understand what a home equity line of credit is. It's really a substitute for a mortgage. Many consumers are shocked to find that the home equity line of credit document, which is usually 1 page, is filed on the land records and is a secure debt, and it can't be discharged in bankruptcy as a practical matter in Chapter 7. I feel that this is a cynical and avaricious attempt by the credit card industry to put a noose around the necks of the consumer by gently, subtly, through subterfuge, using a soft euphemistic term like put the equity in your house to work for you and don't let it just sit there. And it's a scheme to turn their unsecured debt into secured debt by connecting the home equity line of credit to a credit card. This is absolutely insidious. And when Senator Warren, Elizabeth Warren, spoke to the credit card industry about responsible lending to a full audience, half of them stood up and walked out, and they muttered under their voices, "She doesn't get it. That's where we make all our money." In other words, through irresponsible loaning of money. So I'm here to testify and give evidence that I've had many clients over the years totally confused about a home equity line of credit. It operates the same way as a mortgage, and the word mortgage means to the death, and they won't use the word second mortgage with it. Oh no, it's called a home equity line of credit. Put the equity in your house to work for you. Just don't let it sit there. I feel that this is insidious and avaricious on the part of the credit card industry, and I would ask that you consider not voting for this bill and voting it down. Thank you very much. I hope I didn't waste over my time. I'm going to submit a written statement too.
Thank you. Are there questions from the committee members? Representative Doucette.
Thanks, Madam Chair. Just one. David, did you say that I kind of missed, you had referenced some federal action or a congressional hearing? Is there a federal legislation or federal law on this specific point?
Not that I know of. I was just referring to Elizabeth Warren going to the credit card industry in Wall Street and giving a talk, a presentation about responsible lending. And half of them stood up and walked out, and they said, "She doesn't get it. That's how we make our money, by overextending credit." So there's no federal committee or legislation pending that I know of on this issue.
Okay, that's all. Thank you.
Thank you.
Thank you, Representative. Are there any other questions? Seeing none, thank you very much for testifying before us today, Mr. Falve. We appreciate it.
Thank you for the opportunity, Madam Chairman, and everybody else.
Thank you. Have a nice day, sir.
You too. Thank you.
Next, we have Tom Swan.
Hi, good morning, Senator Miller, Representative Doucette. Thank you very much for having me today. My name is Tom Swan, and I'm the Executive Director of the Connecticut Citizen Action Group. On behalf of our thousands of member families, I want to thank you for raising SB 179 and Act concerning cash refunds for gift card balances and urge its passage. This is a basic issue of fairness. Consumers should not have to spend additional money to access the full value of a gift card. Increasing the cash value to $5 from $3 is a small amount and the right thing to do for families, especially when the cards are already paid for. At a time when we are seeing record corporate profits, this is a small but significant step for leveling the playing field. Thank you again for raising this, and we really urge its passage. I'm going to comment quickly on some other bills. We too share concerns with 5218 on home equity credit cards. We support 183 in terms of fair lending. We support SB 178, the Community Reinvestment Act. We support 180, interest rate assigned to municipal tax liens. And I mentioned already 179. So thank you very much and have a great day. And you guys have a good, busy agenda today, I can see. I can't hear you, Senator.
Oh, sorry. I want to thank you and your organization for supporting the SB 179, the gift card bill. And those are my sentiments exactly. I think it's a good consumer protection bill. And as you stated, the cards have been purchased and consumers should not be held in bondage to purchase more in order to use the card. So I again thank you for your advocacy on this and your support. Are there questions from the committee? One of the things I want to mention, since there are no questions, the equity bill, it's the reason we brought that to the committee today, because you're the second person that testified on it, is that right now, the way is those individuals that have home equity, they only have access through a check. And so we're just modernize it to allow them to have access to the monies through a debit card, through a card. So it's not to get a new card, but it's just so that those individuals that have mortgages or the home equity will have access through the usage of a card. So I just wanted to bring that to your attention.
Okay, I'll take an additional look.
Okay, thank you. Are there any other questions? Seeing none, Tom, thank you so much. And again, thank you for your support.
Thank you so much. Bye.
Bye. Next, we have Walt Smolinski. Sorry, Walt, I got it out, Smolinski. We can't hear you.
Okay, I just unmuted. Can you hear me now? Thank you very much. And you did well with the name. Thanks. Good morning, Senator Miller, Representative Doucette, Vice Chairs and Ranking Members. My name is Walt Smolinski from Newington, Connecticut. And I'd like to thank you for the opportunity to speak in support of RSB 180. I'm a senior citizen and a homeowner. And so what I hear today is concerning. In particular, in my town, there is no notification provided for a second tax bill payment each year. It's my responsibility to remember to pay it 6 months later. So as you can see, I'm fortunate enough to remember to do that. But if I should forget and miss the payment, I could end up in a situation that we've heard before. But moving on, I have a few other thoughts quickly. In this age of low interest rates, and I'm getting 0.2% of interest on my savings, it seems wicked for the state to be getting 18% compounded monthly on anything. That interest rate on the delinquent property taxes seems punitive in this COVID era, where many ordinary citizens still struggle week to week. And we know that inflation and property values are rising faster than paychecks. So reducing the interest penalty rate to 12% per annum will give ordinary people a better chance to catch up on their debts. And keeping citizens in their homes is a vital social good. And I think the focus should be on supporting people trying to build an ownership dream. And I believe that this bill will be a big help. So I thank you very much for the time and the work that this committee does. I see a few familiar faces, and again, I thank you for your work.
Thank you, Mr. Saplinski. Questions from the members. Representative Delnicki.
Thank you, Madam Chair. And thank you, Walt, for coming forward and with your testimony.
Sure.
I have to ask you a question pertaining to your tax bill from the town. Do you, or let me rephrase that. When you receive that bill, I'm going to say in July, do you receive two bills in there, one for payable July 1st and one for payable January 1st the next year?
Yes, there is the coupon for the second payment, the second installment. Yes.
So you are given notice in that one bill, but your commentary was that there should actually be two mailings, the first one in June 30th for the July 1st bill, and then a second mailing, say December for the January bill?
Yeah, well, there's kind of two parts to that. Yes, in the past, the town has done this in the past. They would send out a mailing for July and a mailing for January. And I think to save postage cost, they've combined them to one mailing in July with the two coupons. But the other side of it is that because I have to take the January coupon and I have to remember that come January that it needs to be paid. And should I forget that, and a lot of older people, sometimes that becomes an issue. It could perhaps go to delinquency without my being aware of it. And I could end up in a situation as we have been brought up earlier in this committee hearing.
I'll just make an observation, not another question. I appreciate the fact that you believe that the 12% is a much more equitable figure when it comes to an interest rate. And my community does exactly the same thing. I live in South Windsor.
Okay.
And I do receive the same type of billing on the billing as you receive. And I have a feeling that probably most towns at this point are doing it that way, just as an observation. And again, thank you for coming forward for your support on the readjustment of the interest rate.
Okay, thank you very much.
Thank you. Thank you for bringing that to our attention, because in my town, we get two mailings, one in July or June for July, or in July for August. And then we have one at the end of the year. And I can't even imagine getting one bill and remembering to pay it in January. So I appreciate you bringing that to our attention. Representative Doucette, did you have a question? Oh, I saw you waving your hand. I'm sorry. I apologize. Are there any other questions from the committee members? Seeing none, thank you so much for coming to us today and testifying on behalf of the bill.
Thank you for that opportunity. Thank you.
Thank you. Next, we have Art Corey.
Good morning, Senator Miller, Representative Doucette, and members of the committee. CBA appreciates the opportunity to testify today on a number of bills. I'll be going first, followed by our President and CEO, Tom Mangello. I'm Art Corey, General Counsel with the CBA. We've submitted written testimony on a number of bills before the committee today, and we encourage the members to review that written testimony, but we'll only be testifying on a few of those. The first bill I'd like to talk about is Senate Bill 183, an act concerning fair lending. We'll be submitting written testimony on this bill shortly. We very much support the underlying goals that the bill seeks to achieve. It's important that everyone has equitable and inclusive access to financial services. We do have some concerns, however. One of the things the bill would do is duplicate current state and federal lending laws in Connecticut's banking laws. The state's fair lending law is in Title 46A of the Connecticut Statutes on Human Rights. That law and the federal fair lending laws are a carefully thought out, comprehensive approach to prohibiting discrimination in the making of loans. In particular, Title 46A allows a consumer to sue a creditor for discrimination or to file a complaint with the Commission on Human Rights and Opportunities, which has authority to penalize and also sue a creditor for discrimination. These laws are robust and give individuals and regulators the ability to take action against creditors that discriminate. Duplicating these state and federal laws in another place, the banking statutes, we're concerned could create confusion, not just for banks and their compliance efforts, but also for individuals who are looking to the law to determine, where their rights are spelled out and what they are. Senate Bill 183 would also amend Connecticut's community reinvestment statute by adding new requirements regarding the advertising and offering of loan products in specific communities. It's important to note that these requirements would only apply to state chartered banks. Connecticut's community reinvestment law is designed to be in sync with the federal Community Reinvestment Act. Our concern is that if these two laws are no longer aligned, it will make compliance in this area difficult for banks. As the Commissioner and Matt Smith mentioned earlier this morning, the federal banking regulators are about to begin a modernization of the federal CRA, and that modernization is expected to focus heavily on equity and inclusion issues. We'd like to suggest respectfully that Connecticut await the outcome of that process and even to participate in it for addressing the Connecticut statute. Senate Bill 178, which was also discussed this morning, which has also been raised before this committee, would establish a working group that would do just that, requiring the group to monitor federal CRA developments and to submit recommendations for changes to federal regulators and the members of Connecticut's Washington delegation. We work closely with Representative Jim Himes, who's on the House Financial Services Committee, on these issues, and we expect to do so in this process with the federal CRA. But the working group would also be tasked outside of the CRA with identifying and recommending ways to help banks provide banking services to underserved and low and moderate income individuals and communities. We support that effort, and we plan on being a part of it, both here in Connecticut and on the federal level. The next bill I'd like to talk about.
Tom, you've extended, you've passed your 3 minutes, so I apologize.
That's all right.
I meant Art, so maybe Tom can pick up where you left off. So thank you.
I had
very
that time
much.
better.
Thank you, Art. We appreciate it.
Thank you.
So our next speaker is Tom Magello.
Hey, good morning, everybody. It's great to be here. Just let me pull up my testimony. I'll go through and try to essentially keep it to the 3 minutes. Okay, so I'm going to be testifying on one bill in particular today, and I appreciate the opportunity to be before the committee. Chair Miller, Chair Doucette, thank you very much for holding the meeting today. I'm Tom Mangello, as Art had indicated. I'm the president and the CEO of the Connecticut Bankers Association. I'll be discussing and asking for your support of House Bill 5218, an act concerning card access to home equity lines of credit. By way of background, the CBA does represent banks across the state, from the smallest, which is New Haven Bank, to the largest, which is Bank of America. This bill would effectively create a parity of products or a level playing field for state charter banks with federal banks. And that's how their customers can access their home equity line of credit. I'll call them HELOCs for short. Federal banks have always had the ability to offer debit cards or credit cards for customers to access their HELOCs. By way of background, when I say federal banks, those are that either have a Fed Reserve charter or an OCC charter and are regulated by those entities. Those federal banks have roughly 83% of the marketplace in Connecticut, which means over 80% of bank customers already have access to this type of product. If a customer wants a HELOC that has card access, they can go right over to a federally chartered bank. It's that simple. And that would also include existing customers of state chartered banks, because right now, Connecticut law currently prevents state chartered banks from doing the same. The only way those banks can allow access to HELOC products is by online banking transfers to checking and deposit accounts, over-the-counter cash advances, and of course, a paper check. Except for the online banking advances. These ways to access customer HELOCs are outdated. Most younger customers, including my 3 adult kids, don't want checks, they don't order checks, and they won't use checks. Customers increasingly want products that are available by easy-to-use electronic means, including the use of cards rather than paper checks. I can't remember the last time I saw one in Home Depot paying for home products with a check. Speaking of checks, their uses across the board is dramatically decreasing. That's proven out by a 2019 Fed Reserve payment study that found in the year 2000 there were 42 billion check payments, and by 2018 it decreased down to 14 billion. If my math's right, that's a 65% decrease, and I'm sure there's even less check usage 4 years later. Another Fed survey basically reported that in 2009, consumers age 18 and older made approximately 13% of their payments with checks. In 2018, it's down to 5% and continuing to drop. Clearly, our customers, especially the younger ones, are moving quickly away from checks, going electronic, including cards. This committee frequently asks us, what can we do to help state charter community banks? This bill is a perfect example of that. And it's also how Connecticut law can be modernized to create that parity of products for those banks, while at the same time providing their customers with electronic access to HELOCs that they're looking for. For all the reasons I've mentioned, we respectfully ask that the committee support House Bill 5218, put state charter banks on a level playing with federally chartered banks, and thank you again for the opportunity to testify. And I'd be happy to take any questions through you, Madam Chair.
Thank you. And Art, I forgot to ask the committee if they would like to have question you as well. So I'm going to allow them to question both of you. Art, I appreciate you staying on. Representative Delnicki.
Thank you, Madam Chair. And Tom, thank you for your testimony here. How long have we had that disparity between the federally chartered banks and the state chartered banks when it comes to the card issue?
Well, as long as I can remember, but
You got muted, Tom. Tom, you're muted. I didn't hear your answer.
Oh, sorry about that. Thank you. So I've been here for about 30 years. So it's been that way as long as I've been at the association, but we can certainly look back into it and see when that actually happened.
Well, I don't necessarily need to know that, but my follow-up is this. What other products are denied for state chartered banks versus federal chartered banks? And I don't expect an answer now. I would like an answer for the committee so that we can take a look at some of those issues in the future.
We'd be happy to do that for you, and thank you for asking the question.
And thank you, Madam Chair.
Thank you. Are there any questions for Art or Tom from the committee? Seeing none, thank you both for testifying before us today, and thank you for bringing this issue to our attention.
Thank you. Have a great day.
Next, we have John, and I've known you for years, and I always seem to mess up your name. So tell everyone your last name, John.
Erlinghauser. And
There you go. I knew that, John. I knew that. You should have waited until I got it out.
Now, you wouldn't have been the first to mix that one up, Senator, but I appreciate you having me this morning. And I'm here. My name is John Erlinghauser. I'm the Advocacy and Community Outreach Director for AARP in Connecticut. AARP is a nonpartisan social mission organization with an age of 50 plus membership with nearly 38 million members nationwide and about 600,000 here in Connecticut. We support livable communities for all ages, aging in place initiatives, financial opportunity and resilience for everyone as they work and age and retire. We're before the General Assembly every year on a multitude of bills that support these issues. Consumer spending is responsible for more than 2/3 of U.S. economic output. Older adults are responsible for a disproportionate share of consumer spending. They represent a powerful force that is driving economic growth and value. This includes products and services they purchase directly, as well as further economic activity this spending generates. According to the AARP Longevity Economy Report, older adults contribute $8.3 trillion to the U.S. economy every year. That also represents 40% of the total value of goods and services provided in the U.S. during the year, and that's also known as the gross domestic product, or GDP. And those statistics mirror, the Connecticut statistics mirror those at the national level. That's why I think it's critical to put in place policies that protect consumers and do not disadvantage them or cause financial strain. Gift cards are financial products that have already been paid for, and they are the equivalent of cash. When there's been very little money left on them, consumers shouldn't be required to buy something for potentially much more money in order to spend the small remaining balance left on the card. That's why AARP supports Senate Bill 179, which increases the minimum balance amount for which a consumer using a gift card may request a cash refund from $3 to $5. This will put more money in their pockets, allowing them to spend it on necessities rather than being required to buy a product in a store that costs more than the balance of the gift card and potentially something they don't need. So we appreciate the opportunity to come before you. I want to thank you, Senator Miller, for introducing this legislation, and thank the chairs and ranking members, the co-chair, Representative Catton, and the rest of the committee for hearing me today. And I'd be happy to answer any questions.
Thank you, John. Appreciate your testimony and your support. Are there questions from the members on the committee? Okay, well, seeing none, thank you again, and AARP for the support of this bill.
Our pleasure. Thank you. You too, ma'am.
Okay, bye-bye. Okay, next we have Jeff Gentes.
I'm sorry, Madam. I've been called. I was just promoted to panelist.
Yes, yes.
Great.
You were.
Thank you.
Thank you.
All right, no problem. Senator Miller, Representative Doucette, Senator Bertel, Representative Delnicki, and members of the committee, thank you for allowing me to testify today. My name is Jeff Gentes. I'm with Connecticut Fair Housing Center, and I co-supervise a clinic at Yale Law School, the housing clinic. I'm testifying today on 3 bills. We have submitted written testimony. The 3 are Senate Bill 180 and then Senate Bills 178 and 183. With respect to 180, we're very appreciative that the General Assembly passed a bill last year that Representative Doucette referenced earlier to regulate tax lien purchasers, and also in doing so enable the Department of Banking to regulate tax lien purchasers as well as part of their supervisory work. And I think that will go a long way towards getting some of the practices that we've seen and some of the abuses that we've seen under control. That being said, anything that we can do to discourage towns from selling off their tax liens, we support. And if it means including this lowering of the interest rate from 18 down to 12% so that the liens are inherently less attractive to investors, for us is a great thing. In terms of Senate Bills 178 and 183, also want to thank this committee and the House for getting, I know Senate Bill 183 out of the House last year in supporting these bills. We think they're important to promote fair lending efforts. At the center in particular, we get more than we can handle in terms of both what we're doing in terms of auditing and testing, in terms of the complaints that we're receiving around, say, certain large banks not doing what they should be doing for lending in Southern Connecticut, and in terms of what, complaints about, say, discriminatory appraisals and the like, and there's more that can be done. We know that prior to Commissioner Perez, there was not an emphasis in the department on fair lending, and we appreciate his interest in this area and support for the work. That being said, the status quo right now is largely relying on my coworkers. We have a lawyer working on this part-time, and I think he majored in finance undergrad, but it's not necessarily, he's not a full-time regulator. We have a person who started yesterday. And while I believe there will be some enforcement actions coming out of my office in the next year or so, I don't think it's something that the state should be relying as a primary local means of fair lending enforcement. So anything we can do to expand the resources and the power of the department would be much appreciated. And with that, thank you for letting me testify today.
Thank you very much for your testimony. Are there questions from committee members? Representative Doucette.
Thank you, Madam Chair, and thank you, Jeff. Good to see you again. 2 questions. Going to ask you, it sounds like you were watching or listening earlier. I wanted to ask you to comment on a couple of things that were raised. One, I think Mr. Roman, feels strongly that the bill last year did not go far enough. So I guess question one is, short of, again, prohibiting assignments or just trying to, reduce the number of assignments to reduce the influence of sort of the potentially bad actors in that field. What modifications do you think we could make to that? We heard a lot about notice requirements too, stuff like that. So I wanted you to comment on that. And then number two, I wanted you to comment if you heard Mr. Corey talk about with respect to fair lending laws, potential conflicts between if we were to enact this bill, potential conflicts between the CHRO statutes and some confusion that might ensue from that, if you think that is a valid concern.
Sure. With respect to Mr. Roman's testimony, I think there were a couple things going on. One was the regulation of debt collectors, and specifically the attorneys who are hired by the tax lien purchasers in the cities to collect this debt. And they are not debt collectors for the state of federal law, nor do I believe state law, because of the reasons that Mr. Roman said. So to the extent that you wanted to regulate those entities, because they're not technically collecting debt, you could expand the collection laws to encompass those, so that to make sure that this was a covered type of debt, so that collecting this debt was regulated. And I believe that's what he was referencing with respect to the federal court decision. Though I was paying some attention, but not total. And that's as opposed to what this committee did do last year, which was regulate the actual purchasers and regulate the terms of the tax lien assignment, so that the municipalities in the would only sell the liens under certain conditions, and then the purchasers themselves would be subject to laws that they hadn't been subject to before, partly because of the tax debt nature of things, as opposed to what would normally falls under consumer debt. In terms of Mr. Corey, the difference between state and federal law in terms of what's in, say, the Connecticut Fair Housing Act and the Federal Fair Housing Act tends, I think, primarily having to do with the protected classes. So to the extent that veterans are a protected class, to the extent that sexual identity is a protected class in Connecticut, to the extent that, it's a little, Supreme Court had a decision last year that sort of wrapped up sexual identity and sexual orientation in terms of gender, but to the extent that those are not covered under federal law, there's arguably more for state lenders to do to ensure that they're not discriminating against people. There's also a question around source of income. And source of income is a protected class. It's typically, what's been litigated is around people who have Section 8. And that was the original purpose behind the law, was ensuring people with Section 8 could be treated as any other renter in the market. And that itself is, we had an appellate argument yesterday about exactly what a discriminatory statement concerning Section 8 is. And we have another case from our state Supreme Court on this issue and exactly what source of income discrimination consists of. There are different, to the extent that Connecticut lenders would also have to think about, we need to treat someone who's employed the same way that we treat someone who's disabled. To the extent that somebody is using perhaps there's Section 8 home ownership programs in certain cities, we need to treat those folks who are applying for loans in the same way as anybody else who, say, has business income. And so that's an additional layer of regulation, but it's consistent with what they already do with respect to, say, their employment practices and with how they should be treating their customers already. And this is, to be clear, I don't know if this is exactly what you're talking about, but this is my an answer to what I think was the concern.
No, that is helpful to know, to point out some areas, particularly with the federal laws that we're tracking. But again, I think part of his point was that, we already have the 46A CHRO, protections that we don't necessarily need them in the banking statutes, that there may be some conflict. So again, if you think of, I'm more curious on that point as we go through and think about ways we may want to further amend this bill as we move forward. So if anything occurs to you, and I'll make the same request to Mr. Corey as well, as we go through and kind of parse the language, if indeed we do make some changes to that bill.
And I view this as a charge to the Department of Banking as well in its supervisory role, that because we have not had that emphasis before, just there's a lot of different things that a Department of Banking could do. We want to make sure fair lending is on their list of priorities, and I view that as one of the fundamental parts of Senate Bill 183.
Yep, I agree with you there for sure. Thank you, Jeff. Thank you, Madam Chair.
All right, thank you, Representative.
Thank you, Representative. Representative Gucker.
Thank you, Madam Chair. Jeff, good seeing you again. Thanks for the work that you and your organization does. I did mention your organization earlier, and I just wanted to ask you, since you're in the room, with regards to Senate Bill 180, with the increased taxes that go to these third-party collection agencies, are you seeing, how is it affecting your organization? What are you seeing in regards to your organization with people looking for assistance and help in this area? And do you think there's any tweaks that we should be looking or thinking about as we go through this legislation?
I think Senator McCrory really mentioned it earlier, which is getting cities to move away from the practice altogether is really the best thing possible. And to the extent that we can make these, that we take property tax debts and turn them into financial instruments, we tried it for a couple decades, and we've seen how it can be abused. And to the extent that we can do more to disincentivize it and have some of these cities and towns that are, they really just, if you value the collection of property taxes, transferring your constituents off to these debt collectors, even if they are regulated, is still something worse than having a city employee where there's alders, there's selectmen, there's people you can go to if you have particular issues with the tax collection, rather than shipping your constituents off to somebody who treats them as an asset as opposed to a member of the community. Anything that you can do to further that would be a positive. Right, repeal the statute, that'd be great. if it's a phase out, cool. I think the legislative session is not the best time to do it, but as we have in the last, just to actually answer your question about how's it affecting our office, we spent a lot of time in the last year engaging with some of the people mentioned during this hearing, some of the tax lien purchasers, seeing what's going on. We've had questions like, why are you charging $6,600 in fees to this homeowner who wouldn't be paying anything more than $24 a year in fees if the city or town were foreclosing? Why are you charging $6,600 in fees? And they turn around and say, well, actually, it's only $3,900 in fees. And having those kind of battles over, especially on individual cases, there's only so much time. There's only so much time that it's worth it for a lawyer to spend to engage in each individual case, picking apart these fees, picking apart the overcharging, the sloppiness, the lack of oversight. And as we continue to do that, and as we now have more of an incentive and the resources to look into these practices, I think we're going to learn about all the other ways that and even more specific abuses that are affecting the constituents. And I think you and I discussed, but this goes for anybody who represents a municipality where they're selling off liens by a property tax or sewer. I think we, having a conversation with the municipal leaders about phasing this process out can go a long way. And, whether it's Danbury or Hartford or West Haven or Cheshire, all these places where it's constituents are just not protected through this process. And we appreciate very much what was done last year to hopefully corral the worst abuses.
Well, thank you very much for all that your organization has done. I've learned so much about the process through both yourself and in this committee. Thank you, Madam Chair, for the opportunity to ask questions.
Thank you, Representative. Jeff, I have a question. So when the municipality sells off the lien, are they selling it for the amount of taxes that's owed, or so that's what?
Yeah, it's typically an auction. So they say you're buying this lien, and right now the right to collect 18% super interest on it. So above the lenders that you're on top of them. And there's typically an auction, and it sort of depends on the municipality as to what people are willing to pay for them. They often pay. I mean, I've heard Cheshire conducting auctions where people are paying 102% of what's owed because they're happy to pay more than what's owed and then sit back, reap the 18% and really eat away at the homeowner's equity until they decide that they're going to their collection actions.
I guess that's the point I was getting to is, do they sell it at a minimum, what's owed to them from the homeowner? All right, thank you. Representative Delnicki.
I'm not sure if they do.
Madam Chair.
With that last part. Sorry.
I touch base on the issue of the sales per se. I can really see how my community has done that. Just as an informational point, is the tax lien sale would be for the principal and the accrued interest to that point. And it would be sold for that face value and not an auction per se. I think most communities are probably doing it that way. My question to Jeff is pertaining to, you were talking about the problems you're having with some of these bad actors. I know Bridgeport had a huge problem. Since the institution of some guidelines, have you had problems with people that have had their liens sold since the Public Act that we passed last year went into effect?
I'm just thinking about the timeline. I think it went into effect in October, and I think the auctions tend to be after no, because they wouldn't be yet in foreclosure, and that's pretty much when we get folks. So in other words, a lien that was sold in that interim period, you buy not only the right to the principal and interest, but you buy sort of a right of first refusal, or maybe even sometimes, depending on how it's structured, the obligation to buy future tax years if they fall behind. And I don't think we just haven't had it because the timing wouldn't work yet. Someone is sort of not yet in foreclosure if the lien was just purchased, especially if you're buying it for above the amount that's owed. In those situations, you want to sit back and collect that 18%. I can say we haven't seen, while there may be rules in place, I'm not so sure that it may take some litigation and case law that I may or may not be cooking up with my colleagues to show that there's some teeth behind the law. And because I can't say I've seen a huge change in behavior yet, but there's only a few actors really in this space. And, I think engaging with one of them in a courtroom could help bring some clarity to what their obligations are.
Yeah, but let me just rephrase the question, because I'm not sure that I understand the answer succinctly.
Okay, I'm sorry.
So any tax liens, any folks that have tax liens sold after the point at which the statute went into effect, you've basically had very little experience with anyone there actually having an issue or not? Because I'm trying to judge, I'm trying to judge how the guardrails that we put in place last year actually are working.
Right.
If we don't have enough experience, you've got to be careful you don't overshoot or undershoot.
Sure. We haven't, I guess there's two things. If it's working tremendously, I don't get calls. So, but I think it's also premature to look too carefully at what's been happening since. I think it's incumbent on, people like my colleagues and I to put some of the, to test drive the new law and see how it does with both realizing a benefit to the people who've been hurt by it, but also changing the behavior. And the same goes for, the Department of Banking. I heard about their staffing challenges too, but now that they have the ability to do more regulation around that area, that might affect behavior as well.
So basically, I'm trying to boil it down to some kind of a answer.
I'm
one
sorry.
way or the other.
I'm not trying to be difficult.
No, I know, because it's new. You know, the guardrails we put in place last year are new. So is it safe to say the jury's out and you're waiting to get a little more experience? But it sounds to me like you really haven't had experience with anyone that had their liens sold right after the statute went into effect. All your business right now is to folks prior to that?
It's all people who are in foreclosure under liens that were sold prior to the bill going into effect. Yeah.
Right. Because I was going to say, I'm pretty sure there's a 1-year clause in there that they can't be foreclosed upon after the sale, if I recall correctly.
So there's that, and I think there's the incentive of the tax lien purchasers is seldom. They usually wait, and it also just might be a function of, as a lawyer, I don't get fan club mail about the creditor industry. So, there was a bill. Our now AG asked me, "Hey, we did this bill in 2011. I think you said it would really help people. Do you know of people who were helped by this bill?" And I said, "No, because they stopped calling me." So my real goal is to eliminate so that we never know, the people will never know they were helped, which is, it's less satisfying as I can get it. It's less satisfying as a policymaker for sure too. But I'm hoping not to have experience with those folks.
Well, I thank you for your testimony, and I'm sure you'll be collecting some data over a period of time to see whether or not the complaints have tailed off on the recently sold tax liens as opposed to the ones that occurred prior to any sort of guideline. Again, thank you, Madam Chair.
Thank you, Representative. Are there any other questions from the committee members? No. Jeff, thank you very much for coming before us today to testify. Have a nice day.
Thank you, Senator.
Thank you. So next we have William Donlin, followed by, after him will be Johnny Moore, after him, Annie Harper. Mr. Donlin, are you here, sir? Do you see him, Dawn?
I do not believe that any of those three are here.
Okay. So if they should arrive, Dawn, just let me know, okay?
Yeah.
Next, we have Paula Bacalini, and I did see her name. I see her here.
Now, if I can,
Bacalini, there you go.
here I am. Trying to get my video on. There we go. Oh, sorry. Hi, everybody. I just want to thank the co-chairs, Senator Miller and Representative Doucette, and the vice chairs, Senator McCrory, Representative Gucker, and I just want to thank you all and the committee members for bringing these bills up for public hearing. My name is Paula Bacalini, and I'm a resident of Glastonbury, Connecticut, and a senior citizen. I'm a homeowner. And in my town, we only receive one tax bill every year, and we get it around beginning of June, which is 2 tear-off pieces, one for June, and then you have to remember to send your bill in January. So I could see how that could really get a person, especially with the pandemic and everything that's going on, I could see how people could actually forget to pay their tax bill. So I am in favor of Senate Bill 180, the act establishing an interest rate for certain municipal tax liens and bringing that interest rate from an 18% compounded monthly to a 12% annually, I think is a fair way to do this. I really wish the towns would be regulated and need to send their citizens a tax bill at every 6 months. That would really be helpful. But anyway, with the pandemic and causing so many hardships for families, I'm testifying today because although this particular tax lien adjustment would not affect me directly, I'm fortunately in a condominium, so I don't have those enormous taxes that homeowners have. And but the fact that this is going to be lowered and will help to prevent foreclosures and keep people in their homes and their properties, especially with all of the hardships people have had with the pandemic. I think this is an excellent bill, and I urge you to please vote yes, vote it out of the committee, and I hope we can pass it. Thank you very, very much for taking my testimony.
Thank you, Ms. Bacalini. Questions from the committee. Representative Doucette.
Thank you, Madam Chair. And I just wanted to take the opportunity to say hello to one of my favorite constituents, Paula Bacalini. Thank you, Paula, for coming to see us here today. I know you're a tremendous advocate on a good number of issues. And I think this is probably the first time I've seen you in the banking committee. So just goes to show you we do some good stuff here as well. But thank you. And thank you for mentioning that, the second tax bill is something that, sort of related, but a little outside of what we're talking about here. But the fact that that's been raised here, and I think we all can agree that that is such a great idea. So thank you for bringing that, and thank you and for your testimony. Good to see you. Thanks.
Thank you.
Thank you, Representative. Are there any more questions from the committee members? Seeing none, thank you again for testifying. Thank you for your advocacy on older adult issues as well and retired teachers. So thank you very much. Okay, next we have Jonathan Klein. Is he here? Yes.
Yes, I am.
Hello, Mr. Klein. How are you today, Attorney Klein? Is it Attorney Klein?
Yes.
Okay.
Yes, good morning, co-chairs Miller and Doucette. My name is Jonathan J. Klein. I'm a partner in the law firm of Parlatory Law Group, LLP, with an office in Bridgeport. I've been practicing law for 41 years, and I'm here to testify in favor of HR number 5214, Act concerning the closing of accounts at financial institutions. The concept of the proposed new subsection E to CGS section 36A-318 is to stop financial institutions operating in the state of Connecticut from closing accounts without any accountability to their depositors. It is standard procedure in the banking industry to include in the fine print of every deposit contract when a new account is opened, a provision stating that the bank has the right to close the account at any time without notice and without stating any reason at all. As banks have become larger and seemingly less interested in doing business with smaller depositors and with processing cash transactions, the current law makes it easy for them to shed lawfully operating small and minority-run business customers, which by their nature handle many transactions in currency and coins. These businesses include small grocery stores, convenience stores, liquor stores, takeout and other restaurants, bars, check cashing businesses, money transmitters, and independent ATM operators. Small businesses which cannot operate without access to significant amounts of cash on a daily basis. And in the case of check cashing businesses, money transmitters, and independent ATM operators are competitors of the banks. This bill would require financial institutions to provide their account holders with prompt written notice setting forth the reason for closing an account. This will help the depositor try to remedy any problem perceived by the bank so that the account may stay open or be reopened. help the depositor avoid the same problem when seeking to open an account at another bank, and put the depositor on notice whether it may have legal rights it may pursue against the financial institution. Without this legislation, banks are able to discriminate against depositors or classes of depositors without any accountability or transparency, cut off small businesses, including bank competitors, from the banking system, and force out of the marketplace small businesses which depend on cash transactions and which service an important and often disadvantaged constituency which relies on their availability. I'd be happy to answer questions.
Thank you. Are there questions from the committee? Representative Doucette.
Thank you, Madam Chair. Thank you, Jonathan, for bringing this up because we had not heard any testimony on this yet. My question to you is, are you aware of any current federal law? We know there's probably not state law, but any federal law pertaining to notice requirements or anything related to closing accounts that affect federally chartered institutions?
There's none that I'm aware of.
Okay. How about even current practice? This is one of those things that was brought to us and sort of seemed like a blind spot. It was not an area of the banking law that I was really familiar with. Are you aware of what even the common practice is of most financial institutions providing notice of account closure?
The common practice, frankly, is just a wall of silence. I've had clients who've been customers of banks for many, many years, and we'll get a letter in the mail saying, dear depositor, we're closing your account as of such and such date. Don't write any more checks. Don't make any more deposits, this sort of thing. And it states no reason because according to the deposit account agreements, they don't have to state a reason. And it just leaves the customer in the dark. I even had one client who had an account closed by People's United Bank, if I recall correctly, and wanted to find out. You ask the question, they say, we don't have to give you a reason, and actually sought. There's a very little used device called a pre-suit bill of discovery to try to get information to see, do I have any rights I can pursue? And that was unsuccessful. So we never got the information. We don't know why. And that is standard operating procedure for all banks as far as I know.
Interesting issue. Thank you for your testimony today. Thank you, Madam Chair.
You're welcome.
Thank you, sir. Attorney Klein, you mentioned banks in your testimony. This committee, I don't know if you're aware that we only have jurisdiction over state chartered institutions. So you have a Bank of America, we couldn't touch them, right? They could still, continue that practice. So I just for a point of clarification for the public that unfortunately we don't have jurisdiction over the federally chartered banks. I'm sorry. Go ahead.
I do understand that, but I'd like to see our legislature do what it can for the state chartered banks.
Oh, yeah, no, it was just a point of clarification because you mentioned banks. And I just to let the public know that we only have jurisdiction over state chartered banks. It's not all banks. So this legislation, we're bringing it forth because we think it's good policy. So thank you very much. Are there any other questions from our committee members? No? Well, Attorney Klein, thank you very much for coming before us today and bringing this issue to our attention.
Appreciate the opportunity. Thank you.
Thank you. Next, we have Melissa Linden. I did see her sign on.
Hello.
Yes, we see you. And we hear you. You have the floor, ma'am.
Yes, I am from Glastonbury and I have the same concerns as everybody else. I have had banks. Well, first of all, I have had the town assessor who's currently frauding my dad's estate and the engineer manipulate tax records within the town of Glastonbury and the collector's office to say my dad's estate is foreclosed on. They've put fake tax liens on me It's all in the courts and nobody addresses it. Nicole. And then your municipal tax lien bill, it absolutely did nothing. You had a representative ask what has been like changed. This just all happened in like the last couple months. And Anthony Aponte went into the town of Glastonbury with a tax lien and journaled my parents' property after they died into a fake bank called US Bank Master Trust. LSF Master Trust Participation, Caliber Home Loans. You're allowing these banks, this fake bank, to seize people's property by affidavit and using them as tax liens and foreclosure certificates. And you're taking people's houses like this. In the Glastonbury especially, you're allowing $500,000 properties to have $3.5 million in municipal tax liens outstanding. 28 Quail Run, look at that. The Islams have gained their whole entire life off an overinflated municipal, whatever you call tax lien or liens in general. There are 2 securities from Caliber Home Loan on my parents' property going to 1 default notice that doesn't even go to the deed. I have just been deemed for foreclosure in the town of Glastonbury. And I've never even had a mortgage in the state of Connecticut. I've been evicted in your housing court and I've never had a rental agreement. And everybody just sits there and goes, oh, we have no accountability. As far as I'm concerned, the state has accountability to tell the federal court that there's fraud throughout your banking system. You collected judgments from Household Realty on our behalf as the state, Joseph Chambers, and you allowed them to continue frauding me, and you didn't even give my mother any money of the settlement. You took our rights, put them in federal court.
Please wrap it up, Ms. Linden. You're approaching your 3 minutes, ma'am.
Okay. And nobody does anything. You have a fake bank saying they paid the taxes when they declared to the IRS my mom paid the taxes. So do you understand what I'm doing? They're using my mom's escrow, like that gentleman said, gave no accountability to closing the accounts when my mom died. And they gave no accountability. All the banks in Connecticut have given no accountability to closing my dad's lucrative estates or where the money has gone. Every bank, every charter bank, you name it. And I have identity fraud. My parents have identity fraud. And your courts have issued orders in dead people's names.
Okay, ma'am, you finished. We've reached the time limit for your testimony. We appreciate you bringing this to our attention, and we're sorry that you've had to experience what you're experiencing.
Because the main thing is, I shouldn't be wearing.
Ma'am, your testimony, ma'am, I don't want to appear rude, but we're going to have to ask you to finish your testimony. Are there any questions from the committee? Seeing none, thank you very much, Ms. Linden, for staying on to testify. We appreciate it. Thank you, ma'am. Next, we have Attorney
Can I say one thing? Can I say one thing?
Ma'am,
I'm sorry, I just want to say one thing.
Ma'am, I'm going to have to, and being fair to everyone else that may want to say one thing, I'll have to say no. Thank you. Appreciate you coming in. Rafi Podolsky, how are you, Rafi?
I'm good. Senator Miller, Representative Doucette, members of the committee, thank you very much for the opportunity to testify. I am an attorney with Connecticut Legal Services. I'm the policy advocate for the legal aid programs in Connecticut. And I filed written testimony on 5 bills, but I'm really going to use this time now just to speak on one of the 5 bills. And that is House Bill number 5218, which is the one about credit cards that are secured by home equity loans. I'm sorry. Essentially, what the bill does is it would overturn a long-standing legislative policy that you cannot use a credit card to access home security, to a home equity. It's been prohibited because it is so dangerous to consumers to use a device that's meant for small transactions to put your home as the security, which means you can ultimately get foreclosed. And that's been the rationale behind it. It's been there from the beginning, since the 1980s. And it has been very important because of the tendency, sort of a psychological tendency to use a credit card for small things. Credit cards normally, because they're so easy to use, you can use a credit card, you pay for your groceries, you buy things in a drugstore, all sorts of things that are small. The debts are unsecured. If you should not pay, credit card companies do a lot of suing in court for unpaid bills, and you can end up with your wages attached, but you cannot end up with your house taken. So this is sort of an analogous issue to some of the other issues you've heard about today. One of the consequences is it really undermines the homestead exemption. And just last year, you raised the homestead exemption a large amount, up to $250,000, so that judgment creditors could not end up taking people's homes if they have equity in the home. But a securitized credit card is a consensual loan, and the homestead exemption does not apply to consensual loans. So it means if you're suing on that kind of a debt, then you can use it as a way of ultimately taking control of the house through foreclosure. It also is an invitation, because it's potentially lucrative, to bad practices if bad actors are in the system. I'm not saying that they are, and this is not an accusation about anything, but structurally, the existing law is designed to make sure these kind of things don't happen. So with that in mind, I would urge you not to do House Bill 5218. I'm happy to answer questions about this or about any of the other bills I submitted written testimony on. And again, I thank you for the opportunity to speak to you today.
Thank you. I'll take the first question. So, Rafi, I have a question. If I have a home equity loan, I now have access to those funds through a check. So what is the difference between me using a check to access those funds and me using a credit card? Because I can still write as many checks as I want on the account. So what would be the difference?
Well, I would say that the difference, when you write a check, well, when you say you're writing a check on the account, I guess what I would say is, I think to me the difference is probably mostly psychological, which is to say it is very, very easy to use a credit card. You don't, because because you think of credit cards as for advance payments. It's not a debit card, it's a credit card, that you kind of don't worry about whether you do or don't have the money to pay for it right away, the way you would ordinarily with a check, because ordinarily a check, you're sort of making sure that you have the money available. I think it's much more likely to be used in that manner. People carry checkbooks with them. I understand that, but it's very easy to carry. It's easier to carry a credit card than to carry a checkbook. It makes a difference for some people. Maybe I would say it's an analogous issue. I don't want to say that there's no connection between the two, but when the legislature initially made this decision, they did not, I don't know if people even thought about using how checks applied in that circumstance, but that wasn't, I think they didn't have it in mind. And this has been preserved. There've been efforts every 5-10 years. There's been an effort to change the statute, and each time the legislature said no. There are too many things, too easy to misuse it, and you end up risking your house. So it's not really a good answer to your question about writing a check. I guess I would say I'd be pretty cautious about writing checks too, but it's not, the check is basically paid for. A credit card is a future payment that you're looking at. So with a credit card, you get a buildup of debt. And that's how you get credit card companies bringing lawsuits. Even if you've got a bunch of $50 and $75 and $100 credit transactions, you end up with a lawsuit for $3,000, $4,000. And then in some people, it just starts growing and growing. I mean, one of the interesting commentaries was what happens if you use this at the casino or at some other activity, which itself has a certain addictive aspect to it.
Mm-hmm. Okay, and just the legislative intent behind this was to modernize people who have home equity loans, to enable them to gain access to the monies more quickly, right? And so rather than checks, because you heard Tom Margella say his his children don't use checks anymore. And so it's just, the legislative intent was to allow those individuals that did have loans to gain access to the money more easily. And so thank you for your testimony, because you just add a different perspective to whatever our intentions were and our intentions are. And so that's why these public hearings are very, very important. So Representative Doucette, you had a question, sir.
Thank you, Madam Chair. Hi, Rafi.
Hi.
Yes, it's a good point you make, and I agree with you. I guess I sort of share the same concern about the psychological piece of it, making it so easy to use, perhaps easier than we want to make it. But on the other hand, with the fact in mind that federally chartered banks can already do this, I guess I wonder, whether or not it makes sense, if that is in fact totally true and there's no nuance to that, I wonder if in fact it makes sense to prohibit essentially our state chartered institutions from doing this. So that's sort of a thought and a question, but really my question to you would be, if that is in fact true and there is no nuance to that statement that federally chartered banks can already do this, can already offer these debit cards, are you aware of any restrictions on that, any controls, any regulation, any case law, or any legislative efforts in Congress or anything like that, that would give us some guidance on how we would do this on the state level?
Well, first of all, the answer is I don't know. And I'd be happy to look and see what I could find out from others who have more knowledge of this than I do. The one thing I would say is that I think you should be cautious, at least in the absence of really clear evidence, as to what can and cannot be done in relation to what we can regulate when it impacts federal banks. And that's been, for years, that's been a question that's popped up many times. And the lines are not always that clearly drawn. For example, I think it was in Senate Bill, I think it's 183 is the number, but where there was discussion about to what extent do our anti-discrimination laws apply to federal banks. I would not assume without some pretty clear evidence that a federal bank is free to discriminate in violation of the State Fair Housing Act. And that's because not everything is included. Essentially, not everything is included. One of the aspects about this particular subject is this, the statute you'll note is not in the banking statutes. The statute's in Title 49. It's a land use statute. So it's not entirely evident that the National Banking Act preempts a land use statute. Now, I'm not saying that it can't be true, and there may be established evidence that it is true in this case. But for example, if the National Bank rents some of its property as an office to someone, is there some reason to believe that the National Bank can ignore Connecticut's eviction laws and simply lock the tenant out? My assumption is that the Connecticut eviction law is not preempted by the National Banking Act. So all I would say on that is that I just wouldn't take for granted that because this has something to do with the business of the bank, it automatically follows that everything that has to do that in some way impacts banking is covered. So I would just say you need to, I don't know the answer, but I wouldn't take it for granted when you're dealing with things that are not in the banking laws of the state of Connecticut. If you would like, I will certainly try and find out if there's anything in federal law that.
Yeah, I'd be curious. Yeah, I'd be curious on that.
Okay, sure. I'll try and
again, your point is taken. This is almost like almost a reverse preemption thing, right? Where we're looking at something that is allowed under federal law and something that it seems is prohibited under Connecticut law. So your point is well taken, but if there is any regulation on a federal level that would be helpful to us in guiding us if we were to do this, I would definitely want to know about it. So if you do come across anything, please let us know.
Okay, I mean, the one thing I can say about it, this is not some new law where we're trying to now start regulating something that's never been regulated by the state before. This is something that's been established in state law for a very long time. And it was indeed, my understanding when it was first put in, was very deliberately done. It was deliberately carved out as an exception by the legislature to a general rule that says you can, to the very things Senator Miller talked about, which is making it easier to access the equity in your home for lending purposes. And I think this takes us back to the 1980s, but it was, so it was done deliberately. It was done a long time ago. You could argue that means it's time to change it, but it also means this is something that has been accepted. But again, I will try and find some more information for the committee. And thank you for asking.
Thank you.
Thank you. Are there any other questions? No, Rafi, thank you so much for your testimony today. And I want to personally thank you for the work that you've done through the years, through the many years on issues such as this, especially the housing issues. So again, thank you for your work and your testimony today.
Yeah, and thank you very much. And just so you should know, I do indeed support the gift card bill, which is in my written testimony.
Thank you. I appreciate that. Well, that brings us to the conclusion of the individuals that signed up today. Are there anyone in the public who would like to speak and didn't have the opportunity to sign up? Dawn, is there anyone?
No, I don't have anybody that reached out after the deadline.
So we have quite a few members that are attending other meetings. And so what I would like to do, Representative Doucette, is to adjourn this public hearing for about an hour until about, let's say 1:30. If that's okay with the committee?
Yeah, that's fine.
Just for attendance purposes.
That's fine. I believe we are only missing one member.
We're only missing one member. Okay. So we will adjourn until 1:15 then.
Thank you.
We'll give that member an hour for attendance purposes only. Again, I would like to thank the public as well as my colleagues for attending this public hearing today, and everyone have a nice day.
You too, Madam Chair.
Thank you.
Thank you, Madam Chair.